What's your max upside for the S&P 500 if you're an analyst right now? Maybe 10, 15%, something like that. Okay, great. Well, based on those valuations, what's your max downside? Especially looking at the labor market. And if we are in that 2007, 2008 cycle, then you've got 30, 40, 50% downside on the S&P 500. And that's definitely asymmetry, but that's the opposite asymmetry.
Right.
That's the bad kind of asymmetry.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Concerns about the weak consumer, the frozen jobs and housing markets, rising debt delinquencies, tariff-driven inflation, stubbornly high bond yields, and geopolitical stresses cause many analysts to worry that the economy will slow materially this year. But others, especially those listening to the Trump administration, are predicting the economy will boom in 2026. From all the AI capex spending, the energy grid buildout, reshoring of manufacturing, capital influx from new trade deals, deregulation, historic tax refunds, and other commerce-friendly developments. So, which is it? Will the economy slow or grow this year? To discuss, we've got the good fortune to welcome back George Gammon to the program. George is best known for his financial education media endeavors, most notably his George Gammon and Rebel Capitalist YouTube channels. George, thanks so much for joining us today.
Thanks for having me on.
Hey, it's a pleasure to have you back on, my friend. Well, look, there's a lot going on in the world right now.
Yeah.
I even haven't had much of a chance to watch it today because I've been recording, but obviously
It's
the
just the taco
president's
trade.
Pardon me?
It's just the taco trade.
The taco trade, okay. But anyways,
Yeah.
presidents at Davos, there's a lot of developments swirling there. I'm sure we'll talk to a number of them. But why don't we start with the question that I just posed here in the introduction about the economy, whether it will slow or grow this year. Do you have a strong opinion one direction or the other?
I think it's important for the audience to know that it's always doing both. It's just to what degree.
Right.
So as an example, what you're talking about there with the AI capex spend, that will probably continue, and I'm assuming we're going to get a lot of fiscal, but that doesn't necessarily mean that the high water mark increases. Because if you have a bucket of water and you're pouring water in at the top, but water's draining out at the bottom, you could just be maintaining that level.
Sure.
And that's what I'm trying to say. So the question isn't whether water's coming in or water's going out, because that's definite. We know that for sure. It's just, is that level of water going to decrease or increase? And usually the two metrics that I would look at the most would be just GDP and the labor market. But what's interesting is they're telling two completely different stories. So you look at, and I think GDP is actually coming out tomorrow. We're talking on January 21st. So that'll be really interesting, or at least a revision. But the labor market, when you look at non-farm payrolls, we've had several negative numbers in 2025. I know it's 2026 now, but back last year, we had several negative prints, and that's before the absolute final revisions. And I went back for a couple videos and did some research there, and I found that that's very rare outside of recession. Now, sometimes you get a one-off because of a big weather event or maybe a huge employer like Walmart, the employees going on strike or something like that.
Mm-hmm. A government shutdown. I mean,
there you go. I was just going to say government shutdown. But usually you just get this bounce back and then you get back to that same mark. It's very rare that you get 3, 4, 5, 6 months after revisions of negative non-farm payrolls outside of a recession. And if I had to place the emphasis on one indicator, it would definitely be the labor market. Mm-hmm. So if I was trying to predict the economy. Now, that said, I don't think that has anything to do with the stock market. Unfortunately, I think that a lot of people get confused that, oh my gosh, if the stock market's going up, well, then all you people that have been bearish on the economy, well, then you're all wrong. And that's not true. There can be an inverse relationship, because bad news is good news. Because if the labor market's deteriorating, then the Fed's going to drop rates, and you get this Pavlovian response where it's Jim Cramer, buy, 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 buy. And you combine that with the passive that our good friend Mike Green always talks about, and that usually leads to the stock market going up regardless of what's happened to the underlying economy. But your question is directed toward the economy itself. So
It
that's why I
is.
wanted to focus on nominal GDP and the labor market. Now, one of those two has to give, Adam. My base case would be that it's going to be GDP, but I don't know. Those two have to match up at some point in time. You can't have the labor market deteriorating. You can't have negative non-farm payrolls and very poor ADP prints and have GDP at 4.3%. Like that that's those two don't coincide. So my guess would be that the GDP comes down, especially after revisions, to what we see in the labor market versus the labor market really, really heating up and going back or getting up to the levels that would be reflective of a 4.3% real GDP.
Okay. Let me say a couple things about that. First off, personally, I don't think we're there yet. Um, but just to your question about, hey, you can't have GDP growth go up if basically jobs are flatlining.
Or negative.
Yeah, or negative, but let's just assume flatlining for a
Yeah.
second. In kind of an AI world where you're getting lots of new productivity from
Mm,
technology, could we eventually transition to an economy like that?
it's possible. It's definitely possible. I mean, what I would like to do there is go back and see when we have these huge fundamental shifts in these transitions, when we become much more productive, like the internet, I think would be good, and see how that kind of played out. But the internet didn't really take that many jobs. I don't know that that's an apples to apples comparison. You might have to go back to like when we were an agrarian economy, and 95% of Americans were farmers.
Right.
And then that kind of went by the wayside, and people had to learn other jobs and they become much more productive. But that happens over a period of what, 20, 30, 40 years, where this could happen over a period of maybe 3, 4, 5 years, something like that. It's definitely a component, and it's something that we need to consider. But if it's taking all those jobs, I don't know that it can increase productivity to the degree to which we would need in order for it to compensate the decrease in jobs. And I think that could be a lot of what we're seeing in the labor market right now, because that's just a complete reduction in aggregate demand. And in an economy, especially where you have to have the money supply grow, I don't like that, but it
Mhm.
kind of is what it is. If you have long periods of time where the money supply decreases as a result of more loans being paid off than are creating, that creates some deflation and disinflationary um, uh, tail or some inflation, excuse me, some deflationary or disinflationary um, currents that could be extremely detrimental. So I think on net, you would see a decrease in GDP overall, but it's definitely something that you got to consider. That's for sure. And I think the latest round of the productivity numbers show that productivity is definitely increasing.
Yeah. And like I said, I don't think we're there yet. I don't think it's kind of we're not going to see go from one year to the next and just all of a sudden see a completely different regime. But it could be a lot faster this time around, and I actually think it will be.
Absolutely.
Um, okay, so let's chew on this topic of jobs for a bit more. So first off, you know, we have to determine if the numbers that we have are even really trustworthy, right? And
Mhm.
the BLS has, I think, taken a lot of well-deserved criticism for
Yep.
its calculations. And even I was kind of shocked. I think this was two press conferences ago by Powell. But even Powell said that the Fed thinks that they've been overstated by, I think, on average of about $60,000, the
Yeah,
payroll numbers.
60,000. Yep.
Yeah, and if you back out that 60,000, then it's uh, job growth was negative for, a pretty good chunk of
Yeah.
2025.
Like the last 6 months, it's like negative 40,000 or negative 20,000.
Yeah, yeah. So, definitely reasons to be concerned. I do think that that was a good chunk of why the Fed was cutting in 2025. It was getting increasingly worried about the labor market. But, things have held together. And looking into 2025, um, well, two things. The Fed was concerned, and I and a lot of the analysts I interviewed were concerned about this trend. But like consumer spending it didn't grow a lot, certainly in real terms in 2025, but it didn't fall off a cliff either. We weren't really
Mm,
seeing a big diminishing, and that's because of this K-shaped economy. So with this K-shaped economy, George, we've got the top half of the K doing great. I've seen numbers, estimates that the top 10% is responsible for about 50% of retail
yeah.
sales. But whatever the true number is, they really punch above their weight, and they're able to kind of mask um, the declining prospects of the bottom 80 plus percent of the K, at least for the time being, right? And that seemed to be the case for 2025. Um, as we head into 2026, uh, at least if you listen to the administration, they're saying, hey, relief is coming for Main Street. We're going to have the biggest tax refunds for the middle class that we've ever had historically. There might even be tariff checks to households. Trump was talking about, I haven't heard much about it recently, but there could
Yeah.
be, direct payments like that. But also just like, hey, we kind of have this slow to hire, slow to fire economy right now, but hiring might pick up because we're building all these data centers and we're building all these new factories that are coming in, and all this, foreign capital that's coming in. It's all going to be great. The golden age is going to start kicking in. If you listen to folks like Lutnick and Besant, and yeah, of course they're going to be cheerleaders for the administration, but they're kind of putting their personal brands at risk by predicting GDP is going to be at least 5. And they've said, look, we can see cases where it's 6% or even higher in 2026, right?
Mm.
So, time will tell who's right here. But I'm just curious, you know, as long as there's not a market correction, right? So as long as the top 10% is, or the top half of the K is still spending a lot, if we get some relief on some of these other things the administration is saying may be coming, um, it's I've got a hold possibility here that outlook, could be improving for the jobs market going in 2026. I won't believe it until I start seeing it in the numbers, but I'm holding it open in my mind that okay, maybe it's not going to be as bad as I thought, say if you'd asked me six months ago.
Mm. Yeah, I mean, it's a good point, but I think my counterpoint there would be, what are we going to see in 2026 that we didn't see in 2025 and still had the negative non-farm payrolls and the deterioration in the labor market? And the point about the K-shaped economy is very, very good, but I don't know that the top 1% spend more next year. I don't know why they would unless we just have like some sort of crack up boom in
Hmm.
assets or something, which you never know. I don't know if you saw the report from Macy's that just came out, where they're shutting down some of their,
Yep.
hub centers or something like this and firing a lot of employees. But what they mentioned is that they have to start catering more to the high end, and because those are the only people that are spending money.
Any money?
And it's
Yeah.
the same thing
Same
with
thing with the
Delta.
airlines. They-
Yeah, I was
They're
going to
they're
say
they're,
with
they're
Delta
now totally
Airlines.
focusing on first person business. Yeah.
Yeah, so you have to, if that is the driver, or if that's what's keeping our head above water right now, then okay, we know that the labor market is likely to continue to deteriorate, so that's going to be a headwind. So for the top 1%, what drives the spending next year above and beyond what it was this year? And I think the probability of that is low, although I think there's a substantial probability that we see something similar where we still are able to keep our head afloat due to the spending from the top 1%, to your point, assuming that asset prices stay the same. And, we got gold all-time highs. We've got
Hmm.
silver going to the moon. So there's a lot of things out there that could lead to, let's say, additional aggregate demand for the top 1%. But at the end of the day, I think those chickens come home to roost. We have to remember that going back to the last big recession that we had in 2008, the lead up to that, the stock market was at all-time highs. Now, it is true that I think there's an increased percentage of aggregate demand coming from that portion, meaning asset prices. But back then, we had housing prices. I mean, that was creating massive amounts of artificial aggregate demand
Yep.
until like 2006 going into 2007. And then the stock market peaked out in October of 2007, if my memory serves me right. And then we saw a gradual decline, then a big decline in 2008. But I don't know that this cycle plays out any different. And what you're saying, you're making very good points, but that's really the argument for Keynesian economics.
Well, I guess what I'm saying here is I can see potential. And again, I'm right now, there's lots of cross currents. So, I won't be surprised which way it goes. I'm just open to
Yeah.
both sides of the equation here. I guess what I'm saying is I could see potential that the job market actually might improve next year with a faster growing economy. And that was sort of the first thing I wanted to talk with you about, and I think we've done that. Um, the second thing I want to talk with you about, though, is the economy and the stock markets are two different things. And they have been so correlated for so long that I think everybody just thinks, well, they're both going to always go in the same direction, but they don't necessarily have to. So now, if we're talking about valuations, which we're getting into, we could have a year of increased economic growth, while at the same time, we could have a poor or bad market. And you're talking
Let's,
about, we're starting it with these nosebleed valuation levels.
yeah, see, that I disagree with.
Okay,
Again, there are no certainties, only probability. But
right.
if you're going to tell me the stock market, the S&P 500, we'll use that as a proxy, is down by 15% in 2026, I peg the probability of 4% GDP growth extremely, extremely low. And if you're talking about the numbers that Trump or the administration, 5, 6%, I'd peg that as close to zero as I can get.
Yeah.
Because, and we
Well,
also have to remember,
let's talk about why, because generally I agree with you that the market's become so important. It's kind of
yeah,
become the tail
exactly,
that now wags the dog.
exactly.
And of course, we're talking about the top the top part of the K, right? If all of a sudden their assets get injured and they pull in their spending, that's really going to impact the economy.
Yeah, to your
But
point, that is aggregate demand right now. That is
yeah,
what's keeping our head above water is asset prices. So if asset prices go down, I don't know how we don't drown in that scenario. At least especially when you look at the curves and you look at interest rates and you look at what they're doing as well. They're telling the story of a slowing of nominal GDP, not an acceleration.
okay. So from your perspective, you're taking the hey, show me standpoint when it comes to what the administration's selling right now.
Yeah, I mean, if you're going to tell me that GDP is even going to stay the same, let's say 3% for 2026,
Hmm.
I would say that we need the stock market to go up by another 25%. And like I said, if you're going to tell me that it's down by 20%, in that world, I'm going to peg negative GDP, the probabilities at 75%.
Okay. So, gosh, so much to dig into here then. Let's start
Especially with
with,
the housing market too, Adam, because I know you touch on that quite a bit,
yeah,
and rightfully so. And right now, I mean, what, 51% of the homes on Zillow took it on the chin last year, have had to take a haircut or at least decrease their price.
right. We had the majority of homes actually lose value last year. Yeah.
Yeah, so if you see that trend continue, and that's really interesting because the housing market is much different than the stock market from a standpoint. It's like the Titanic. Once that thing's moving in a certain direction, it takes a long time for it to turn around and go back the other way.
Right.
And right now, I think you're seeing that transition, if you will, where it's starting to go back the other way, and usually that doesn't play out for 5, 6, 7 years like we saw when we hit the peak in 2006 and we hit the bottom in 2012 of
Right.
August, about 6 years. So you figure, if we're 2 or 3 years into that, you've got another 2 or 3 years to go. So you would combine a reduction in overall home equity in addition to, let's just say, a decrease of 20% in the S&P 500. And that to me is aggregate demand. And so that's why I peg that probability so high. It's not just the stock market, it would be a combination with the housing market as well.
Okay. It makes total sense to me. So, let's, I just want to get your opinion on valuations. So, for much of the past several years, um, stocks have risen to historic valuation extremes, and
Yeah,
they
yeah,
still are there right now. By metrics like whether it's CAPE ratios or Buffett indicator or whatever, we're at, if not all-time high. I think Buffett's at all-time high, but CAPE ratios are almost at all-time extremes.
yeah.
Um, so, do you have a forecast or at least an outlook for 2026 in terms of the markets? Do you think they're going to be able to hang out here, or even extend their multiples higher, or do you see some triggers that could potentially, force some sort of pullback or correction?
I think it goes back to labor market because for that, I think what really moves the needle is passive.
Okay.
And so if you have the unemployment rate under 5%, and let's say the job market does not continue to deteriorate, I think that could be enough of a tailwind
Okay.
to even push the
Just with those big
valuations.
passive flows coming from the
Yeah,
retirement buying. Yeah.
yeah, yeah. Now, a lot of people they watch your channel and they get some incredible information. And most of the people that come on your channel say that yes, we're at these nosebleed levels. It's insane where we are. It's definitely in a bubble, and I would completely agree with them. But unfortunately, and my viewers are the same, they take that to mean that you should go out there and short the S&P 500.
Yeah. Yeah.
And
Which,
that is
yeah.
a very, very, very dangerous game. And that is something that I would highly advise against just because you do have that, what does Mike call it? The brainless robot or whatever
The giant mindless robot.
there you go. The
Yeah.
most basic algorithm of all time. You don't want to fight that. You don't want to fight that. I think that's way more powerful than the Fed has ever been. And so I just don't like to get in the way of that freight train. So I think there's other ways to play it that are a little more strategic. I think maybe the last time that we spoke, I talked about that spread trade. And if
Yeah.
you want me to at the end of this video, I can explain that. But that's done very, very well. I would much prefer to do something like that if I have a bearish view on the valuations than just buy puts or something like that.
Okay. And I'll let you know that great minds like yours are in great company. Not only have I had, guys like Mike Green on who have just said, hey, look, I hate the fact that this passive bid is distorting the markets and creating kind of a sort of Damocles for the market where everything's going to be fine up until the point this thing reverses, then it's going to be
Yeah,
chaos. But he's like, but
yeah,
it is what it is. And he's done the work to isolate the passive factor. It's now something he's actually trading on. And he says, look, as long as that thing is going the way it is, you'd be foolish to fight it. But I also had Carson Block on from Muddy Waters last week,
mm,
one of the most respected short sellers still in the business.
yeah,
And he said the same thing. And actually, he actually is licensing Mike's data on the passive bid and using it to make profits on the long side. And he's just
yeah,
saying, yeah, I don't think he's like, I'm not that interested in shorting this market unless I've got an activist lever to pull. And he's like, I think if you're a regular person, you're nuts to be shorting. So, anyways, he thinks very
yeah.
similarly to you.
Especially with, I had lunch with Mike a couple months ago, and we were talking about this specifically. And I don't, it might be proprietary, so I won't give the exact number. But Mike said that he's modeled it out, and there is a line in the sand with unemployment where he thinks the passive will go from net buying to net selling.
That's telling, yeah.
So that's why I refer back to the labor market if someone's actually trying to time that.
Okay. I'm going to actually see Mike in person next month, and I'll ask him that same
Are
question.
you going to
And
go to Jeff's deal?
no, I'm going to go to Grant and Stephanie's
Okay. Okay.
conference in Florida. Um, but I'll ask him too if it's proprietary, if that's something that he doesn't mind sharing, and if he is willing to share it, folks, I'll let everybody know.
Yeah.
And I'll let you know too, George, that you can share that publicly with your audience too. Um, uh, just because you've met Mike in person, I've interviewed Mike a fair amount over the years, but I've yet to meet him in person.
Hmm.
But he's one of those guys, I think, from what I've talked to from other people, is he's a pretty tall guy, isn't he?
He's a big dude.
Yeah.
He's a big
And
guy.
it's funny because for some reason, he doesn't come across that way on camera. It's kind of like Brent Johnson. When I met Brent for
Yeah.
the first time, I was like, oh my God, you were giant.
Yeah. Yeah. People
Yeah.
say that about me too.
Yeah, you are a tall guy. Yeah. Yeah. Okay. So yeah, I'm mentally preparing myself not to be surprised then when I see him in person.
Yeah.
Um, all right. So I agree with you that I think, so goes the labor market, so goes the economy, and the markets for 2025. Um, I guess let me ask you this, just how much do you worry about just valuations in general, right? They're a
Mm,
terrible timing tool, but I guess for you, you're probably not going to worry about them too much until the passive bid starts struggling.
yeah.
Um, uh, okay, and how
I mean,
much?
I worry about it from a standpoint of its impact on the economy. And the example I always use, Adam, is it's like a hot air balloon when the economy should be the balloon and the stock market should be the basket.
Mhm.
But unfortunately, what we have today is the complete opposite of that. It's the stock market is actually the balloon and the economy is the basket. And that's where I really worry about valuations. It's not necessarily because we could go into a big decline or 20, 30%. It's just the dependence that the economy now has on the stock market is what I worry about.
Yeah. And maybe, well, I'll get to my question here eventually here. Uh, but so we've got, again, kind of the sword of Damocles of just valuations are kind of perpetually elevated at this point in time to extremes, and at some point that will likely mean revert, and then it could have really dire impact for the economy. And obviously, a flipping of the passive flows from positive to negative could be a trigger for that. Another one just could be the AI trade just kind of rolling over,
Yeah.
right? And so we talked about the importance of AI capital spending this year, but there's definitely been more skepticism growing in the AI story as 2025 moved on. And then, recently here at the beginning of 2026, yeah, I'm starting to see real stories questioning things like OpenAI's business model, right? That like, hey, the company seems to be in an internal panic. It seems like, Google Gemini might be kind of eating their lunch. But I mean, and we've got concerns about the circular financing, which of course we had during the dot-com boom and whatnot. But how much do you worry, if at all, that the bloom just comes off the AI rose enough?
And that is the S&P 500, and the S&P 500 is the economy.
Yeah, exactly. I
Yeah.
mean, yeah,
Yeah. Yeah,
yeah,
I think that's a great point. And there is no doubt that AI is the future. And we all agree on that.
right.
And it's
But
just,
just like the internet, will it be the future as fast as
yeah,
current valuations suggest? Yeah,
it's simply a matter of when. It's not a matter of if. But that doesn't necessarily mean that the current business models are profitable.
right.
And I mean, you look at
Or sorry to interrupt,
OpenAI.
or that the capex is going to continue at the rate that it is. I mean, there's a
It,
danger
it
that companies this year might just say, "Wait a minute, we're spending a ton and we're not
yeah.
seeing incremental revenue yet." Yeah.
It can't. It can't unless they come up with a different way to monetize, which will probably be ad driven or something like that. But until you get to that point, I mean, you've got OpenAI that's generating, right off the top of my head, I think it was in the 12, $15 billion worth of revenue. And like 80% of the globe uses OpenAI. So it's like, where's your growth strategy there, right?
Yeah.
And what are you going to charge people more money? You're already giving it away for free. And every single one of those queries costs you a hell of a lot more than 20 bucks a month.
Yeah.
When you combine it, if you're like a power user or like most people, where even for me, uh, uh, Chat GPT has almost replaced Google from a standpoint of search. Or at least, if I did 100% search 4 years ago, now it's probably 50-50
Right.
between Chat GPT and actually just Google search.
Right. And
So
even folks who use Google search, a lot of them are just now using the AI Gemini summary at the top. They're not clicking any of the links
yeah, I
below
do
to
that
make
too.
money. Yeah.
Yeah, I absolutely do that too. So I think if your listeners and viewers just look at their own habits and how they have changed and how they interact with the internet over the last year or year and a half, you see the direction this is going. But even you've had this massive growth, like unbelievably breakneck speed, but yet they're still not even close to making profit. And then you sit there and you ask, well, how are they going to do it with their existing business model? And the answer is they really can't, because at the end of the day, AI is a commodity. It's a commodity. So unless they figure out a different way to put up a moat or to create some sort of monopoly where they actually have pricing power, it's just simply a race to the bottom, where it is true that delivering the service will get cheaper and cheaper and cheaper and cheaper, but there's also going to be more and more competition that's willing to charge you, 5 cents less than the other guy just
Right.
to connect to that commodity. It's like a barrel of oil. And until you get to this point where the current businesses that are out there are really charging their input cost plus 1%.
Right.
And it's
Again,
like
it's just like the
AT&T.
dot-com era, right?
Yeah.
Everybody was saying, look at all my eyeballs. And everybody fell in love with that initially. But then they said, wait a minute. What we really care about at the end of the day is profits, and none of you have them. Yeah.
Yeah. And again, I'm sure they're going to come up with new models over the next 5 or 10 years or something like that, apps or who knows, that will be wildly profitable. But as the businesses are right now, and that's what you've got to trade on as far as the price and the stock, there's no way. And you sit there and you look at NVIDIA, and the argument there is, oh, they're wildly profitable and all these things. Okay, that's great. But, I was reading a statistic the other day. I don't know if this is fake news or not, so your audience can fact check me. But it was like 80% of NVIDIA's revenue comes from like 10 businesses.
Yeah.
It's like, and then you look at, so
And
sure,
businesses that
NVIDIA's,
it's often giving the money to then buy back from.
yeah, yeah, exactly. So sure, NVIDIA is profitable, but when you look at their customers, they're not profitable in the slightest. And they go from all this capex spend coming from the savings component of the balance sheet, or from profits from cash flow, whatever you want to call it, and now it starts turning into debt, and that's usually when you start to see the cycle. I'm sure Carson pointed that out
Mhm.
specifically. That's kind of when you see that
That late
fundamental
stage.
shift,
Yeah.
that
Yeah.
paradigm shift, and that's what we're seeing right now. So I think that's definitely going to be a headwind for the market going into 2026. Which, again, the reason that's important to your point, and what I would suggest your audience think about, is how relevant or how crucial the AI companies are to the S&P 500, and then how crucial the S&P 500 is to the majority of 401ks, and how crucial that is to aggregate demand in the overall economy.
Yeah. I mean, the thing is that I don't think they need to reflect on that all that much, because I think everybody knows the answer, which
Yeah.
is, they are crucial to the S&P, and the S&P is crucial to everybody's retirement funds.
Yeah. I mean, I think what you have to do as an investor is just look at the asymmetry, because at the end of the day, that's really what you're looking for.
Hmm.
You're looking for a lot more upside than downside based on the probabilities. And if you're telling me right now that you look out into 2026 and the upside, we've just got way, way, way more upside than we've got downside. I mean, I don't know how you're coming to that conclusion. Now you can sit there and say that, yeah, your base case is that we're up 5%. Okay, that's fine. But what's your max upside for the S&P 500 if you're an analyst right now? Maybe 10, 15%, something like that. Okay, great. Well, based on those valuations, what's your max downside? Especially looking at the labor market. And if we are in that 2007, 2008 cycle, then you've got 30, 40, 50% downside on the S&P 500. And that's definitely asymmetry, but that's the opposite asymmetry.
Right.
That's the bad kind of asymmetry.
Yeah. That's a great way to say it, George. All right. Well, okay. So I want to use that to again go to sort of your outlook for this year, real quick. This is fake news, but I tweeted, I don't know, it was a month or two ago, kind of at the height of all this circular investing in each other's companies, and I put up a false headline that said NVIDIA stocks pops 12% today on announcement that it's taking a 10% stake in NVIDIA.
Yeah, I did this. I did the same tweet. I did this. I swear I didn't see that. I had a very similar tweet to that.
Great minds.
Yeah, so I'm right there with you. Exactly. That's when it was just getting completely ridiculous. And I'm like,
As
okay,
the visual for it, I took a surge protector, right?
yeah,
The
plugged it
surge,
into
and it's
itself.
plugged into itself. Exactly. Yeah.
Yeah. Yeah.
Yeah.
Yeah. I mean that, but I think Nvidia is down since then pretty substantially.
Yeah.
And
Well, that's because Wall Street read our tweets, of course. Yeah.
there you go. There you go. So, again, what's your upside there? What's your downside? And I think that's where people need to be prudent.
Okay. So yeah, I think you did a really good job of saying, hey, the asymmetry doesn't seem to be favorable right now, at least for the dominant trades like the AI trade. Um, you've already told me you'll take the under on economic growth for this year versus projections. How about for the markets? I mean, first off, just statistically, we've had three 20%-ish years of return in the
Yeah,
stock
right.
market, which is
Right.
historically aberrant. A fourth year, just statistically, would be really hard. But obviously, then you factor in all these other, factors that we've been talking about here. Do you, you know, up, flat, down? Do you have a general outlook for 2026 for stocks?
Yeah, what's interesting is I think it depends on the decline.
Hmm.
So what
And
I mean
obviously, it'll
by
depend on
that,
what happens in the labor market. You've been real clear about that. Yeah.
yeah, but if you have like a 20%, let's say we get, yen carry trade or black swan or something blows up.
Oh, you'll
And
have a
as a
fast central planner response versus if it's
exactly,
just a slow burn. Yeah.
exactly. I think if you get a
Like a
big,
2022, another 20.
yeah, if you get that, I would say market's probably up. But if you get a slow grind down that really doesn't catch the attention of the central planners and it's really not that big of a deal, or it's not that big of a crisis to impact the midterm elections, and they just kind of sit back and don't do anything, then I think you could be down, 5, 10%, something like that. That'd probably be my base case. But I think that you're going to have some volatility, that's for sure.
Yeah.
And it just depends on how extreme that volatility is. And ironically enough, I think the more extreme it is, the more likely the response from the central planners, which feeds into that Pavlovian response from the market, which increases the odds of the S&P 500 ending the year higher.
Okay. All right. That makes total sense. And by the way, when I mentioned 2022, that was a year I think that it was slow enough that it didn't
Yeah,
give the central planners an excuse to say, okay, we got to step in and do our usual,
exactly.
so, all right. So, you got your and the Fed hat on, George, as you're wont to do. So let me trundle over into the precious metals.
Yeah,
So they've just had a phenomenal run,
yeah.
phenomenal run. What is your take from that? Is this all just these things have been suppressed, mispriced, whatever, and the world is waking up, especially now that it's becoming much less globalized, and everybody's just realizing, hey, this is where true value lies, and we need to get more of it, and it's just true price discovery that's going on, or are there other things that are driving it? And I guess where I'm going with all this is after this big run, what's your attitude from them with them as an investment heading into 2026? Stick with it, prepare for a big pullback because it went too far too fast, or look, this thing's just getting started, and buy it with both hands still.
Well, I'm a big believer in trend is your friend.
Hmm.
So if we're just looking at it from a standpoint of what to do with your portfolio, I can't give you one personal investing advice, but I'm always going to stick with the trend. And right now the trend is definitely up. So now I think it's important to answer the question why,
Hmm.
because you can't just exclusively look at a chart. You've got to try to understand the fundamentals to the best of your ability. And one of the biggest mistakes that I see investors make is they get something right or wrong, and they assume the reason they got it right or wrong is because of what they think, and often it's the opposite of that, if that makes sense. So I can explain further in that let's assume for a moment that George Gammon came on Adam's show and said that the S&P 500 was going to go up by 20% in 2026 because the sixth moon of Jupiter is at a 46-degree angle in its
Hmm.
orbit as opposed to a 45-degree angle. Or yeah, obviously I'm just making this up.
Yep.
And and then let's just say that we fast forward and the S&P 500 goes up by 20%. Does that mean I'm right? Not really. And in fact, if I do get that right as far as my prediction in the market, but I come to the wrong conclusion as to why and what the fundamental drivers, that's really dangerous. That is really, really, really dangerous, because then what you usually do is double down on that, and eventually you're going to lose big,
Right.
because you're going to keep doubling down, tripling down, quadrupling down, and at some point the house wins.
Right. And for the
So
wrong reason. Right. It's
yeah,
back to the
so
old Mark Twain. It's what you know. It's not what you don't know that gets you in trouble. It's what you know for sure that just ain't so. Right.
yeah, that's right. That's
Yeah.
right. So when you look at gold, for me, and I could be wrong, but for me, it's not about what the normal narrative that you hear, and silver as well, which is debt and deficits. Because if you go back and look at research, the price of gold, and you try to find some sort of driver or some sort of correlation, as an example with inflation, a lot of people think gold is an inflation hedge, which over long periods of time it definitely is, but that doesn't mean that it is from year to year. And so just because the price of gold is going up, that doesn't necessarily mean that it's predicting inflation or money supply growth or negative real interest rates or a lower dollar or any of those things that have been associated with the price of gold in the past. Because again, you don't have to take my word on it. Just do a simple study and look at a chart of gold and then line it up with the CPI, line it up with those other things, and you're not going to find a correlation at all. But the
Right.
one thing where you will find a correlation, and I think today is a great example of that, is counterparty risk, right? Counterparty risk. So what I'm referring to specifically, Adam, is Trump over the weekend or whenever he stated that says that he wants to take over Greenland, and he's announcing these new tariffs, and he's going to put a 4,000% tariff on champagne or whatever
Mhm.
he's saying, right? And the market's like, whoa, 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 we didn't see that. So increase risk. You see that, and then what happens to gold and silver? They catch a huge bid. And
Right.
then today, Trump comes out and says, like he usually does, well, actually, I was just joking, and it was just kind of a late night on Twitter or Truth Social. And yeah, we're going to go ahead and, yeah, those 10% tariffs, that's not going to happen. And what happens to gold and silver? They tank, they completely sell off. And then what you have is the stock market rip, and you have interest rates plummet at the long end, the exact
Right.
opposite, right, of what
Right.
happens. So
And,
I think,
and just to validate that, that's exactly what's happening as we're talking
oh, is
following.
it?
Yeah, yeah. I mean, well, at Davis, Trump, right before we got on, Trump just issued a Truth Social saying, "Hey, I've just worked out the framework of a deal for Greenland
Yeah.
with the uh, Secretary General of NATO, and therefore I'm not going to put the tariffs on Europe that I was threatening." And S&P zoomed, and precious metals got whacked.
Yeah. So I think that is just in a microcosm, it tells you really what's driving price. And this goes back to Russia invading Ukraine in 2022 and us freezing the assets. And if you're these central banks around the world, and what are you going to do? You're going to buy something that doesn't have counterparty risk and that can't be seized by the US government. And I think that's where it's gold started picking up steam.
Right.
And then you have more and more and more geopolitical risk. You have Iran. You have us going in and grabbing Maduro. You have Greenland. You have, all the countless things that have been going on, and that drives gold even higher. And then you basically have a catch-up trade with silver, which we just see pretty much every single time in this cycle, where if
Yep.
gold goes up by 60%, at the end of the cycle, silver would have gone up 200%.
Right.
And so I think that's really the main driver of what's happening with the price. And so that said, understanding that, when can that stop? It can, but I think the probability of us having less geopolitical risk and more certainty in 2026 is very, very low, especially
You'll
how
take
things
the
have
under on
started
that
off.
too. Yeah.
And so that's why I think there's fundamental tailwind for the precious metals. And then again, you combine that with a chart where the trend is your friend. I would not be surprised, especially gold, silver maybe, but gold especially. I would be very surprised if it ends 2026 lower in nominal terms than where it started. But I'd let the chart make my decision. So,
Okay.
if once that trend goes in the other way, then I'd probably take off some of the position. I'd never sell everything because I always want to own some gold,
Right.
but I may kind of trade around that in a more strategic fashion.
Yeah. Okay. Totally get it. Thank you. I think the only factor I'd add to what you talked about there is just what's going on with supply right now, especially with
Mm,
silver.
yeah.
That is a different factor this time around than we've seen in past cycles, where supply is getting really tight. And I think a factor with that kind of speaks to your point about both geopolitical risk and or geopolitical tensions and counterparty risk, where people are now saying, "Hey, look, we're realizing this is a more essential element than maybe we were paying
Hmm.
attention to before, and we want it, and we want to hold it ourselves." And
Yep.
so I interview regularly, and I just did a few hours ago, Andy Scheckman, who is precious metals, longtime precious metals dealer. So he's got his finger on the pulse of what's happening with the physical flows of the metals, and he's saying that we are just seeing record monthly. Um, uh, what do you call it? At the end of the futures contract, people stand for delivery. And he's
Mm,
saying we're seeing record amounts of withdrawals from the system by all these futures contract holders who were standing for delivery, where in the past they were just settling in cash.
yeah.
And they're of such a size, um, and they don't really in such deep pockets that they're not really using margin, that he suspects that they've got to be sovereign entities, that these are actually countries that are stepping in to, increase their strategic reserves. And what's interesting is in the past, to kind of cool off, the price mania, the CME would increase margins up until the point where, costs be prohibitively expensive to transact,
Right.
and then that would cool off all the bidding. Since these guys don't really use margin, they're just shrugging it off. So, how long this will last, that's to me, that's a key question. Is this something that's going to continue for a long time, or will the supply chain heal and whatnot? I don't know. That's a risk there, but it's an additional factor to what you're talking about, and I think it plays into those same trends. Speaking of silver, I just got to ask you this because I heard you mention this on your program, George, and it really surprised me. And look, you do a great job of what you were talking about earlier of, hey, just do the analysis, right? It's one of the things I really appreciate about you is you will make a statement and then you will go back and say, okay, well, look, let me tell you why I'm making the statement. I pulled the data.
Yeah.
Everybody thinks this is the correlation. It's not. Let me show you
Yeah.
why. Um, so you're great about that, but you're also just very transparent, not just with your thinking, but about when you get things right or when you get caught by surprise. And I believe I heard you say, I missed the silver run up.
Oh
I
yeah.
didn't own silver. And I
Yeah.
was a little bit shocked by that because I figured you were a guy who had his finger, his hands in the precious metals to some extent at all times. So did I hear right? And if so, just
Yeah.
just tell me why.
Yeah. So I played it with an outsized position in gold and then the gold miners.
Okay. I mean, which have
So
done well. So it's not like you made a bad trade. Yeah.
yeah, but I sold out of the miners a couple months ago, and I just played that for disclosure. I just played that with the GDXJ. So I was hesitant with silver because of the industrial component.
Hmm.
And when you look, you're sure you got supply side issues, but you could have some serious demand side issues as well if the
Sure.
economy slows down. And so I looked at that, and that was why I didn't pull the trigger on silver, and I preferred to play it just through gold and the gold miners as far as that catch-up trade. Because usually you see gold go first, then you see the
Right.
gold miners, and you see silver, which is exactly what has happened. And that's really why I missed it. I should have done a better job of reading the charts and just relying on history as a guide. And usually, if you've had a cycle play out a certain way 9 out of 10 times, just like with interest rates, or just like when the Fed cuts and the stuff hits the fan, there's no guarantees, but there's just a higher probability, and you should be playing that probability. Now, to be fair, I did get in on silver. I bought. I'd have to look at I've got a log in Rebel Capitalist Pro when I do trade alerts for my portfolio. It was maybe 3 weeks ago or so I bought silver.
Okay.
So on that, I'm probably up, I don't know, maybe 15% or so because it's
I was going
moved
to
so
say, yeah.
much.
Yeah. Especially if you bought after it corrected, which was probably
That's
about
what I
that.
did. As soon as I
Yeah.
saw the breakout and it corrects a bit, then I think, if my memory serves me right, that's where I went ahead and bought. And so I've made a little bit of money on it, but nowhere near as much as I've made on gold, and nowhere near as much as I have made on the gold miners.
Gold miners. Let me show you something. Just when you were talking, you made me think about this. These are charts I pulled today. Um, Here is a chart of gold versus the gold miners. And
Mm,
this chart's a
great.
little bit hard to read, but the yellow line here up on top, that is GDX, the
Okay.
gold miner, major gold miner
Yeah.
ETF.
Yeah.
And then the green line is gold. And first off,
Mm,
you can just, this is over the past 12 months, and you can see first they just crushed the S&P, right?
yeah. Yeah.
So all precious metals owners can pat themselves on the back. But here the gold miners have performed their historic role of being a levered play on the price of gold.
Right.
Right. Now, I have heard some people say, boy, I actually thought they'd have done even better. So maybe the miners still have a little bit more of a catch-up role to play, but, they've pretty much been 2x. They've returned about 2x what the metal has done in that time frame. Let me compare that to this. Same chart, silver miners. This is the SIL ETF versus
Mm.
the price of silver. Over the past year, look at this. Their return is about the same.
Oh, so the miners haven't moved near as much as they should.
Exactly. Or the metal has run way further than it should, and it
Yeah,
could have a
right.
big violent correction. But just assuming that silver kind of sustains here or goes even higher, to me, this seems like a coiled spring potentially here, where the silver miners, to fulfill their true role of being a levered play on the metal here, they should have a fairly dramatic leg up again if the silver price sustains around these levels.
Yeah. What I would want to do if I was going to make that player consider that is I would want to go back and look at past cycles and see how long they usually run.
Hmm.
And then compare that to this cycle and to see if we're kind of long in the tooth or if we're typically in inning 3 or 4. And based on that, I would, and then also too, I'd want to look at a chart. I'd want to kind of try to time it. But if I'm going to do that, I'm gonna have a hair trigger on hitting the bid in case I'm wrong,
Meaning on
because
the sell button, yeah.
yeah, because that as your viewers know that's risk. That's a speculative play for sure.
It's
And
absolutely a speculative play.
yeah, yeah. So, I might do that with 1 or 2% of the portfolio, but I think where retail kind of misses the boat on that one is they do it with like 20 or 30% of their
Yeah,
portfolio. And that's when they can't sleep at night. And when you can't sleep at night, you make bad decisions.
right.
And
Well,
if I'm going to do a shout out, I'd like to do a shout out to Marty Zweig, his rules of investing. I think I mentioned that last time,
you did.
and I just cannot recommend that enough. That's something that he did in, I believe, 1990, and it's just priceless information. It's really proven itself over time.
All right. Well, look, so, that's the precious metals. Sounds like you think the trend is still favorable. So, you are playing them with the positions that you're in. But of course, it shouldn't be all your portfolio, as you just said. What are some of the other themes or specific assets that have your attention coming here into 2026, given this type of year that you see ahead, which could see greater volatility in the markets? I think you said your base case is the markets might be down 5 or 10% by the end of the year. And it seems like you think the economy is not going to perform all that great.
Mm.
And then, of course, there's a lot of wild card factor in there, given the volatility and other things that we talked about. So, what else is on your slate for a year that looks like this one?
In that environment, you most likely get a bull steepener. And so I think it's being boring, but I think that was my favorite trade last time, which actually worked well because I think last time we talked, it was maybe at low 50s or something like that. And now it's, I think, around 65, 67. So that's been a good one for me as well. That one's a little tricky though, because you've got to buy futures. You've got to go long the 2-year treasury and short the 10-year treasury. And because of the duration mismatch, you've got to buy a lot more of the 2-year than you do of the 10-year. So you've got to, that might not be just for the average Joe and Jane. But that's probably what I like the best because if you look at a chart of the twos, tens spread, and you can just pull up a Fred chart of that, you
Yeah.
see that when we go through these cycles, it plays out just the exact same way every single time. And again, it doesn't necessarily mean that it's going to play out the same way this time, but it's just a matter of probabilities. And you
Okay.
see the
Sorry
ace.
to interrupt, but just so folks here, because we didn't define it, bull steepener, that's basically where your yield curve is
Steepening.
expanding, but it's
Yep,
because the short end is coming down.
correct.
Yeah.
That's correct.
Yeah.
But what I really like about it, Adam, is let's just say that Lutnick is right. And let's say Lutnick is right, and we do have 6% GDP growth because of the AI productivity gains, because of fiscal and all those things that you talked about
Yep.
at the beginning of the conversation, then you're likely going to have a steepener. But it's not going to be a bull steepener, it's going to be a bear steepener, which is the opposite, where the long end goes up
Right.
more than the front end.
And that's
But it
really
doesn't.
because that's the bond vigilantes saying, look, we're worried, you got to pay us more, right? It's not a sign of necessarily confidence in the economy.
No, I don't know. It's the opposite
Oh, okay.
because it's growth and inflation expectations increasing.
Okay. Yep. You're
So
sorry, you're
it's
right.
growth
But
and
again,
inflation.
they're demanding a higher price because of that inflation.
Yeah, because they've got alternatives for their money that where the risk reward makes more sense.
Sense. Yeah.
So especially the big banks, they're going to buy fewer treasuries or maybe even sell some because they would much prefer to lend into the real economy because there's more opportunity there. And again, that risk reward makes sense. And therefore, interest rates at the long end go up. And that's usually why they kind of trade alongside of nominal GDP, which is kind of growth and inflation expectations. So if the economy booms and Lutnick's right, then great. You get a steepener. You win. It's just a bear steepener. And if George Gammon is right and the economy kind of grinds to a halt, maybe we even get a recession, maybe the labor market deteriorates further, and we do have a down year in the S&P 500, which is definitely a tailwind to aggregate demand, or excuse me, a headwind to aggregate demand, then most likely there's going to be more Fed rate cuts than are priced into the market right now. And you're going to see that reflected in the 2-year Treasury going down a lot faster than the 10-year Treasury. And we're talking about yields.
Yeah.
And that would be the bull steepener. So the way you lose on that is if you get a flattener. And if you look at that chart that I'm talking about, that Fred chart of the twos and tens, maybe your editor can throw that up. And
Okay.
you
Yep.
look at past cycles where we go into a Fed rate cutting cycle. And usually what happens is you start from an inversion and then you usually top out at plus 200 basis points or so. And just to reiterate, right now we're at maybe 65 or 67 basis points. So when we go back to the asymmetry that you want in your portfolio, you've got a lot more upside there than you do downside with, even if we get a flattener, the chances that we go back to inverted, probably pretty low. So
Mhm.
that would be your downside of, let's say, 65 basis points, and your upside is maybe another 150 or even more. And usually what happens in these cycles, Adam, and because if your editor threw up that twos and tens chart, you'll see just the thing go parabolic. And I'm talking about the spread. And that's usually because you get the bull steepener because the Fed's dropping rates. And then what happens is you come out of the recession and then you get the bear steepener. So you get the bull steepener first, and then you get the
Yeah.
bear steepener. And that's usually why you go from an inversion all the way up to like a positive 200 or 250 basis points.
Okay. So I think you mentioned that at the start you referred to it as a bull steepener trade, but it's really just a steepener trade.
That's correct.
Yeah.
That's
Yeah.
correct.
Okay. All right. Fascinating. Well, folks, there you got something to go check out. All right. So, George, it's always great talking to you. I see here that we've run over the hour here.
Yeah.
Let me ask you this just as we start to wrap up here. Um, is there you know, is there a trend or a concern or an opportunity that is just burning brightly on your radar that I just haven't been intelligent enough to
Yeah.
ask you about yet?
Yeah. Uranium. And I know that will be relevant to a lot of your viewers because they're interested in commodities.
Sure.
And if I'm just using a proxy for the Sprott Fund or the Sprott Physical Trust,
Yep.
and I think it's what is that, Adam? SRUUF.
Yeah, exactly. Yep.
Okay.
SRUUF.
And I know that because I just bought some. And so if you zoom out and look like a 5-year chart, and then you look at a 1-year chart, you see a bit of a breakout. And going back to the trend is your friend, you're starting to see higher highs and higher lows. And we all know the fundamental story for uranium. I mean, over the long run, you 5, 10 years, you've got a super, super, super bullish fundamental story. And it seems like the chart now is starting to play ball. So, full disclosure, I just took a long position in that Sprott Uranium Trust, and that's probably my favorite trade. I think you could see like the speculative capital go from silver and really start funneling into uranium. We'll have to see. Just like I think the crypto speculative capital went from crypto into silver. And that's one of the reasons why you've seen such a dramatic move over there as well. You could see the same thing with uranium. But bottom line, fundamentals look great and the chart looks great. So I just took a long position there.
All right. Just FYI, in Trump's address at Davos, he did really emphasize that the U.S. is going big into nuclear. So for what it's worth, you know,
Yeah,
the
I mean, you've got a lot
administration,
of political tailwind as well.
yeah. Um, I'm curious, are your current thoughts about playing that the nuclear opportunity? Are you going to basically stick with the actual, source itself, the fuel itself, uranium, or are you looking at any of the other nuclear stocks, right? The Oklos of the world, the people that are actually going to be building the reactors?
I should, but I don't have time.
Okay.
I,
Okay.
I should, but I just don't have time with, it's, what I've got going on with family
Oh, it's an
and
honest answer, which is great. It's the best kind.
yeah,
Yeah.
yeah. But for your viewers, if I'm going to give you some advice, don't do what I do. Don't do what I do, and just do some homework. Even if it's 2 hours a week, and you're going to find better opportunities there with better asymmetry.
Well, look, I'm gonna disagree with some of that, which is I know that you have a, community amongst your followers where they can actually subscribe, and I can't recall what you call it, your inner
This is Rebel
circle.
Capitalist Pro.
Okay, Rebel Capitalist Pro,
Yeah.
where like when you do things like take a new position in something like uranium, you're letting everybody know, you're explaining why you're doing the trade. The community can talk about it with you. Okay, well, why are you doing that? And what about this risk and stuff like that? You'll also let people know when you start to sell too. So I definitely think, George, that people who really appreciate your insights and think you've got a good beat on what's going on, that's a great resource for them. So let me get to my wrap up question here,
Sure.
which is for folks that have really enjoyed this conversation and would like to follow you in your work, George, where should they go?
Well, they just follow me on YouTube, or they can follow me on Twitter, or they can just Google Rebel Capitalist Pro, and I'm sure something will come up. But it's not just about me, Adam, and Rebel Capitalist Pro. It's more so that Brent Johnson, our good friend,
Yeah.
is in there. He's one of the pros. And Patrick Seresna from Macro Voices is another one of the pros. He talks about options all the time.
Hmm.
And Chris McIntosh is in there as well. So it's the value far exceeds just little old me. Because I'm probably the amateur in the Rebel Capitalist Pro. So
Uh,
anyway, but that's how people can find me. I appreciate you giving me the opportunity to do a little plug.
no, 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 no. Look, it's you've got a lot of well-deserved fans there, George. I want to make sure they know how to find you. So, George, when I edit this, I will put up the link to your YouTube channels, your X handle, and to Rebel Capitalist Pro. Folks, the
Okay.
links will be in the description below the video as well, so you can go there with the one click. Um, all right, my friend, I can't thank you enough. It's such a pleasure to get a chance to spend a little bit of time with you. I hope we get to see each other in person again this year. I'm sure we will. Probably, I know we always see each other in New Orleans, but hopefully we meet up before then too.
Absolutely.
All right, well, now's the time on the channel. We bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by John Lodra and Mike Preston. Gentlemen, thanks so much for joining us. Mike, why don't we start with you? Any key reactions there to the great discussion with George?
It's really cool to watch you and George talk today. John and I have been longtime followers of George. First time I was able to meet him, and it was a pleasure, and it was an honor. Just a couple of high points here I'd like to point out. George talked a lot about the labor market and the labor market likely being softer than the numbers have said that they are. In fact, you guys were talking about how job growth might have been overstated by 60,000 last year.
Yeah.
And if it
And by
really
the way,
was
not our
overstated,
opinion, the Fed's. That's Jerome Powell's out of his mouth.
which is crazy, which means that, jobs have actually been flat to maybe down, negative. And, the big theme here is you can't have GDP growth and flat, certainly not negative job growth. So jobs have to be growing robustly to have robust GDP growth. So it's a real concern that if jobs are weaker than we thought, or even if they weaken from here, then it's going to be a big negative for the stock market, certainly at these valuations. And George rightly points out that stock markets are ridiculously overvalued. The macro is really bad, but rightfully so, he says, don't short the S&P. A lot of people that have tried it over the years have learned the hard way. It's really literally near impossible to short the S&P 500, particularly with, as Mike Green says, the giant mindless robot. And you guys talked about the mindless robots switching from buy mode to sell mode at some point, but the problem is that nobody knows when that's going to happen. So it will happen, particularly during this with this backdrop of macro overvaluation and the Fed having to be all in all the time intervening. We just don't know what the catalyst is going to be. Everybody wants to know. Nobody knows.
Yeah. Hey,
But
Mike, real quick, let me just remind viewers. So, the guy who's been closest to tracking the whole passive capital flow as the giant mindless robot is Mike Green, which we mentioned several times. Mike has uh, assured me that if and when his data tells him that the passive flow is starting to break down, that obviously after he, tells his own clients that, he will then come on Thoughtful Money and let us know. So just rest somewhat assured that we'll give you the earliest warning of changing dynamics to the passive capital flow if and when they start to occur.
I've got no doubt that the giant mindless robot starts selling when it feels enough pain. And George said that he had a lunch or a talk with Mike, and they were talking about some level that they think that that would happen. I've got no doubt that the giant mindless robot will turn around and do the opposite at some level. Nobody knows what that is, but the whole market is really just made up of psychological human beings. And when they feel pain for the first time in a long time and it's not immediately rescued, they'll start selling. So that's the big risk. So George talked about really if he was an analyst, what would he say is the upside here? Maybe 5, 10, or 15%. What's the downside? I don't think he said this, but if you look at the macro, if you look at valuations, I think the downside could be 60 to 70% because based on statistics that are really meaningful in terms of what future returns are likely to be, we're three times the value of what the S&P would have to be to have average valuation or average returns of 8 to 10%. So, you might literally have downside of 60 or 70% here and upside of 10 or 15%. And I kind of agree with that we might have a blow off top and it might give us 10 or 15%. But then if we lose 50, 60, 70%, what was it for? It's just a move that really kind of destroys everybody. So that's how dangerous it is right now. And I guess I'll just finish with a couple things here. He thought that in 2026, it really depends upon what the Fed and central planners do. I'm not sure I completely agree. I think that gives them more power than they really deserve, even though they've been the only name in the game for 15 years. I really think we're getting long in the tooth of this thing, and really long in the fourth turning that we're living through here. And I think we're really deep in it. We haven't seen the crisis or the climax of the fourth turning yet. And the crisis, in my mind, is when the stock market tops and falls very hard, and the climax comes a couple of years later. I think and I believe that the things that we're seeing, plus, the relentless up action in the market says that we're closer to the peak of the market. I wouldn't be surprised to see that happen this year and not a big down move. In the meantime, it's all about looking at our indicators. Our indicators are really strongly positive right now, and thus we're relatively bullish. Not largely bullish because of our viewpoint and our hedged risk approach, but our indicators are bullish. Just today, the Russell 2000, if you look at ticker symbol IWM, the ETF that tracks it, it hit a new high. The S&P had a pretty big reversal. We'll see if the S&P makes a new high in the coming days. If that happens, we could have a little bit of a run here.
Hmm.
I think all that's going to do is suck people in, and that's what you have to be worried about. So I'll pause there, but I thought it was a good talk, and it's never a dull moment in the markets here. I think that we're in a very critical time.
Yeah. Um, well, the concerns about valuations and how far this could fall. And Mike, you've done a good job over the past many videos of doing the math to explain why a 2/3 drop in the market. You can make a pretty credible argument that would be much closer to fair value for the market. And of course, markets overcorrect on a correction too, so it could go even lower, as unimaginable as that may sound to people. The problem is those are bad timing indicators. And as you said, we're starting to see breadth improve. And there's a whole bunch of other things that may be coming into the mix. And I listed a whole bunch of them, kind of parroting what the administration is putting out there. It's just the kind of thing, as George said, like you don't want to be standing in front of this shorting. And you don't even necessarily want to be just going all to cash, right? We've had people that did that several years ago, sometimes 5 years ago, 10 years ago for these same concerns. And then they've been missing, all the appreciation since. So, part of it is a little bit about trading the market, or an important part of it is trading the market you have, not the market you think we should have, but still, keeping a wary eye out for the fact that, at some point in time, natural market forces may gain the upper hand. And so you want to make sure that you can be nimble and protect yourself when that does eventually happen. John, anything to add to what Mike said about the discussion with George there?
I would just like to give props to George and his hat. We've been quite critical of the Fed and the interventions, and what says it more loudly than the Fed hat that George was wearing. So I want to give props to that. Of course, we don't really think the Fed is going away, but it would be nice to have something a little less politicized and truly independent. But we can all dream a bit, right? No, I think Mike covered George's comments, and I'll just add that we as Mike said, we've valued his perspective on a lot of things for a number of years. So great to connect with him, chat offline with him a little bit. One thing I want to talk about. So here we are, 2/3 through the first month of the new year, and in some ways, things have remained the same. Some of the very strong themes from last year have continued. Yet in other ways, things have dramatically changed in terms of what's moving in the market. So as much as the kind of the great, giant mindless robot kind of theme is very much in play, I would caution folks to not interpret that to mean that there's not value in being selective and tactical, because we certainly see that there is. And let me just share a quick graphic that I whipped together here, just to kind of talk about what I mean. This is actually just year-to-date returns for various glimpses of the market and different asset classes through yesterday, close of business yesterday, January 20th. And so let's start with the broad market. So first off, notice this: the S&P 500 through yesterday was actually down on the year. Okay,
yeah, it's the laggard. Yeah,
and why is that? Some of the themes like the Mag 7, the AI hyperscalers, those stocks have really struggled on a relative basis so far this year. And you see that, for example, just comparing the S&P 500, which is a capitalization weighted index. That index is, I want to say, something like the top 10 names, I think, are over 40% of the, approaching 50%. I may have that wrong, but point being is a very small cohort of stocks. These large hyperscalers have an undue influence on the moves of that index. All well and good when they're going up, but the opposite is the case when they're going down. And that's borne by comparing the equal weighted S&P 500 index. That was up to 2.3%, more or less, year to date. Big outperformance there. That's a new development so far this year, new trend. Look at Mike talked about the Russell 2000. That's up through yesterday, over 6%. Versus again, I kept the Nasdaq off here, but the Nasdaq was down about 1% through yesterday. So a lot of these tech names have really started to struggle. Let's look at precious metals. Of course, the story continues to be that precious metals and commodities have continued to do well, but especially precious metals. But look at broad commodities; they've done so far very well. It's a trend that has continued from the latter part of last year's. Bitcoin has struggled this year. So-called digital gold has really struggled, not only so far this year, but in much of the rally of the end of last year. That's a notable divergence that continues. Precious metals, even just today, have outperformed Bitcoin. Look at the sectors. What do you see at the bottom of the barrel? You see things like technology, you see things like financial, communications. These are the sectors that largely outperformed last year. and they are bottom of the barrel now. And we use systematic tools to kind of tease out these trends. So, for example, we dumped our financial sector allocation, I think either I want to say sometime in November, and rotated into global mining and metal stocks. And those are the kinds of things that have done well, and energy, for example. A lot of basic materials type stuff. So there's definitely really textured movements underneath the surface that one would otherwise miss if they were just kind of adopting this, hey, the passive flows, all you need to do is buy an S&P 500 index fund. That it's quite a bit more texture than that, and we have a toolkit to hopefully help tease that out. So I just want to kind of comment on that.
Well,
The
so
other
let
thing
me,
I would just talk about. Oh, go ahead, Adam. Let's pause there.
well, yeah, let me just ask you a question there. So let's assume that the tech growth sector kind of just remains anemic in terms of its performance in 2026.
Mhm.
Can the rest of the market pull the S&P up to another, attractive double-digit year, or does it need growth now because that has become such a massive share of the market?
Well, the cap weighted index would certainly struggle to make, meaningful new highs if that cohort was struggling and didn't meet its earning targets, for example, which are very rich for the year ahead.
Right. Because I think the
But that
Nasdaq,
doesn't mean,
you said those 10 stocks were like 40+% of the S&P. I think it's like 60 to 70% of the Nasdaq, right?
yep, yep, very very hard to have capitalization weighted indices make meaningful new highs if those stocks are starting to stall out. But that doesn't mean you have to be stuck in those capitalization weighted stocks. You can pick sectors. You can be in
Right.
smaller caps. You can be in some of the equal weighted.
Yeah.
That
The,
can make a
the
big difference.
individual active investor can find their pockets of opportunity, but I'm just trying to underscore this is kind of the deal with the devil you make when you allow uh, a small number of companies to become that dominant. Is it's great when they're doing well, they pull everything up with them,
Mhm.
right? And people that are in general indices, are really happy for that. But when they struggle, all of a sudden you find, Jesus, it's hard to get return anywhere if you're just staying in these sort of standard, indices, which of course a lot of people's retirement accounts are in per se.
Yep, absolutely. The other couple quick comments I'll make. George talked about his take on where the bond market will likely be. He's calling for a bull steepener, but more broadly, he talked about playing this through a steepener trade where
Mhm.
you would go long the 2 year Treasury on the presumption that short-term rates will fall faster or rise less than longer term rates, depending on what scenario we have for an
Mhm.
economics scenario. I think that's a very plausible scenario. I think we would agree with George that we would take the under on the pretty eye-popping administration projections of what GDP is going to be in the year ahead. There was one point I know they were talking about double digits, which is just absurd. I think it's probably no point in history where we've seen that kind of growth. So yeah, we would take the under, meaning that probably more sluggish economic growth than what the administration is talking about. And that's not a political statement. It's a statement about where we are in the economic cycle as much as anything. Um, and precious metals, we agree that the trend is your friend. As bullish as we have been and our clients have benefited, we think that longer term, precious metal prices are probably going quite a bit higher. And this is a statement about, again, the regime that we're in. And even the folks like Ray Dalio are talking about, a complete, change of regime here in terms of what central banks, view as adequate collateral in terms of the kinds of assets they want to hold. That doesn't mean, however, that precious metals can't see a near-term pullback, and we think that's quite a likely scenario. So while we think the trend is your friend, absolutely, our clients who are real people that have lives and wishes and dreams and needs, it's a perfect time to think about cashing in some chips here on this strong move. Many of our clients, I just talked to a client today that had a tripling in a silver investment that we helped them get into, and we just took out all the profits, and they still got a nice position there to keep riding, but they're going to do some other things with that money,
Mhm.
live their lives, use it to travel, use it to improve their home. These are what it's for real people.
Hey, so John, so there's rebalancing, right? And taking gains off the table as you have them, some gains off the table as you have them, which is just part of standard, you know, good stewardship of portfolios. Um, but to your point about the trend being your friend, when do you think about de-risking? Do you think about de-risking as it continues to rise and just saying, hey, this is really getting extended? Or do you actually wait until you start seeing a breakdown in the trend before you start
Yeah.
de-risking?
So there even within a nice tidy uptrend, there can be extremes. So let me just pull up a chart of silver. I'm going to pull up a chart using SLD, which is an ETF, and I know Mike can probably do his usual kind of more comprehensive review of the precious metals market. But there are times where an uptrend can get a little overheated. And if you can see this chart, this is a daily chart of SLV. Let me just zoom out. This is a monthly chart. I mean, and we probably should be looking at this as a log chart, not a linear chart, but
Yeah.
which would kind of make this extreme look a little less extreme. There's a good reason to do it that way, but I won't get into that. But zooming in on a daily chart, there's several lines here. I just want to give viewers just a quick legend here. This green line here is the 50-day moving average. This kind of light purple line or light blue line is the 21-day moving average. It just and then this red line is what's called the Bollinger Band. It's two standard deviations above and below the 50-day moving average. We've seen silver walking up this Bollinger Band at an increasingly steep angle. That usually suggests that you're gonna see a snapback in the short term. It can walk along that band for a while, but you get some sharp pullbacks along the way, like this and this. It would not surprise us at all to see this pullback even to just the 21-day moving average. So that's going from in this chart 84 down to 73. That's a pretty decent pullback, right? And so what do we do in those kinds of scenarios? Well, certainly trimming position size. We did some rebalancing yesterday to trim some position size, but also hedges. We have had hedges on our silver as well as our gold mining stocks. And those hedges can take the sting out of these short-term pullbacks and give us the opportunity to reset those hedges so that we can kind of hopefully continue to ride that trend higher. It's a very dynamic thing that we do it with a very hands-on approach. But those are the kinds of things that even a very solid and healthy uptrend can, in the short term, get stretched to the upside and increase the probability of near-term snapbacks where you want to be a little cautious.
Okay. Mike, we'll come to you in just a sec and let you do the precious metals wrap up because they continue to be doing great still. Gold earlier today, it hit an all-time high, and silver is flirting with it. So right now, John, from New Harbor's perspective, what asset classes or strategies are you guys finding most attractive right now, given the market environment?
Yep. Well, somewhat not surprisingly, the areas that I showed earlier on in the graphic of year-to-date performers, we're heavily into a lot of those, and it's not because we're looking backwards. We actually rotated into a lot of those towards the end of last quarter, let's say, of last year. And why is that? Is because we saw systematic relative strength improvements. For example, we saw financials starting to lag dramatically compared to, for example, healthcare and energy and basic materials. So we rotated into this, and we think those will likely have continued move to run and room to run. And the valuations of those sectors are far better than, for example, the tech stocks. And so we like basic materials. We like commodities, non-dollar denominated assets, both bonds and stocks. We have an increasing nearly half of our equity exposure. We have about 47 and change percent equity exposure right now, still underweight equities, but nearly half of that is in non-US equities denominated in local currencies. We have a targeted allocation, for example, to Latin America, which has been one of the strongest, international sectors. Emerging markets have done very well. New highs even in developed international markets. So that's where we, generally speaking, we're tilted more to international stocks rather than U.S. stocks. We still, again, precious metals. We have broad-based commodity exposure. We think the base commodities, base metals, and things like that have more room to run. They've been very strong of late, and these are kinds of things that certainly you would expect to do well in the kind of a possible inflationary environment with stimulus and fiscal and otherwise. So that's where we see things right now.
Okay. And in terms of those sectors, healthcare, base metals, et cetera, How are you tending to play them? Are you playing them via sort of a sector ETF, or are you actually
Yep.
picking individual companies?
Yep, sector ETFs. We found that a macro sector rotation approach works really nicely. You avoid a lot of single company risk, and and this certainly in these kind of index-driven markets, oftentimes it's what's happening in the sector that drives the move, not the individual company kind of news or whatever. So our play is predominantly through sector and geographic ETFs.
Okay. And I want to ask you guys about natural gas because it's just going bananas the day that we're talking here.
Hmm.
Um, and I think largely what's driving this is they're suddenly expecting colder weather in the US than they were before.
Yeah.
I don't know how you can have your expectations change that dramatically, but
Yeah.
maybe you guys have insight on that. But
I'll tell you about that, Adam. I'll just tell you the first decade of my career, I was in the energy industry before making a mission-driven career change. And one of the last companies I worked for was Enron. People know Enron, infamous Enron. And so I worked in close collaboration with the energy trading desk. And every week, the AGA, the American Gas Association, will put out their what they call their weekly storage report. This is the report of inventories of gas storage. Many people don't know that a lot of to meet peak demands, there are storage facilities, literally, and oftentimes they're underground caverns that they pump with natural gas just to put it in storage so that they can easily and quickly release that gas to meet demands. So that storage report was like one of the most closely watched things on the trading desk, and it could move things in an instant. Though, and what drives those short term reports? The weather. So the fact that it's no surprise we have some pretty cold weather forecasts across a big part of our country. So you're going to see some crazy stuff. In many ways, natural gas is an uninvestable commodity, in my opinion, for everyday investors. It's so volatile and it's so driven by short term weather forecasts that it's not a supply and demand thing from a big picture structural thing.
okay. Well, I just want to show people visually how crazy today is. So if you can see my chart here, you can see right here at the very end on the right-hand side, you can see the dramatic, I think right now it's about a 27% increase in just today on the price of natural gas. And this is what, like almost a 2-year chart. You can see nowhere in this history did gas move anywhere nearly as much in a 1-day basis as it has right now. So yeah, this can be a kingmaker or a widowmaker, right? I'm sure there are some traders today who are doing, they're just making complete bank, but I'm pretty sure there are going to be some guys carried out on stretchers today too from this.
Yep, and there's been some spectacular hedge fund blowups in this commodity itself. Amaranth Advisors, you might remember in the early 2000s, I think it was, blew up on a bad natural gas bet. It's a very, very tricky commodity to invest in.
Yeah. All right. But if you're increasing your exposure to energy there at New Harbor, I'm sure this is just one additional helpful development along the way, although who knows how long-lived this one will be. Mike, why don't we come to you and you can give a quick recap of what's going on with the precious metals, and then we'll wrap up here for folks. But the momentum generally continues here, right?
Sure, I think you guys covered it pretty well. George talked about being in the gold trade, and he just bought silver, I guess, not too long ago. But absolutely, the trend has been your friend, and he's a big trend guy, and I can't agree more. As John said in the video, when he showed in the on the video the chart a little while ago, we've been walking up along the Bollinger Band, and that often happens in super strong markets, and you don't want to short that because you just don't know how far it's going to go. But you do
Hmm.
want to be careful if you're getting overexposed to take profits on the way up. And so all of that is to say that I can't tell where the top is here. I've learned a long time ago not to try to call the top, but we're getting really close to big round numbers. 100 on silver and 5,000 on gold. And I guess I'll show the chart because I always show the chart. I know John just showed it, but I'll bring it up here because I know that some people are going to be talking about today being, potentially a key reversal day. And I don't think I'd read too much into it. But here's silver. Silver hit a high yesterday, and then actually had a pretty good recovery late in the day, but it sold off, and it's got a couple red bars. So some people might be concerned about that. Gold was a little bit more a little more extreme.
Yeah. Can I just share something? So I was recording earlier
Sure.
today with Andy Scheckman, and somebody in the chat said, "Yeah, it looks like silver's stuck between 93 and $94 an ounce." It's just like, are
Oh
you
my
kidding
goodness.
me? Like it just hit them the past week, and these are such extreme numbers relative to its price action. Like, how can you be bitching that it's stuck already?
It's doubled, Adam, in a month or two. It's
Oh, I
doubled.
know. I mean, it's just
So, but
I'm like,
that's, that's the Wall Street bets crowd. Everyone wants everything instantly. But th this trend is incredibly strong. I don't have the Bollinger Bands on here, but look at the 21-day moving average. It's well above the 21-day. Every little dip was immediately bought. We're sitting here. This is the SLV ETF at 84. Spot silver somewhere around 91, 92. So who knows? We've got a little bit of an uphammer, but also 2 days of red. Your guess is as good as mine. I wouldn't want to fight this trend. I wouldn't want to short this trend. Let's put it that way. And that was silver. Here's gold. Gold was up like $90 an ounce this morning, and then
yeah,
it pulled off, and I think it ended up around 50 or 60. But this chart is beautiful as well. Big base breakout where this line is here. We broke out a couple days, went sideways, and broke out strong again. I'm thinking that the trend is still up, just like George. I'm agreeing completely with George, bottom line. I think you talked a little bit about the silver stocks not doing better. For instance, SLV. SLV's done fine, right? But
you
it
mean
hasn't had
SIL?
I'm sorry, SIL hasn't had the expansion that silver has had, or SILJ, the juniors, but they're still doing great. They've had some pretty big reversals here today. The only time will tell if that matters. But this is SILJ. This line, I can actually take that line off, but that was there because it's a fairly important level that we've broken through and we're hanging out. But we've had breakout after breakout after breakout, and each one has just been followed by consolidation and a higher. So I wouldn't want to stand in front of that train, but I also wouldn't want to expose my whole portfolio to it. So I'm agreeing with what John said earlier, trim on the way up. But still, I think and I know it's getting a little bit overheated, but I still think the trend is up, and I wouldn't be expecting a top imminently.
Okay. Do you?
Adam, one thing I
Yeah.
wanted to interject here on the silver miners, and we've talked a lot about this internally here. There are very few silver miners that are pure play silver miners.
Right.
In fact, oftentimes the silver is just kind of one of many byproducts of their mining. So it's not entirely surprising that you'd see the silver miner cohort as a whole not kind of track as levered to the price of silver as, for example, gold miners would to gold. Just something, textually that I think is important to understand in that sector.
Yeah, I talked about this earlier today with Andy. Yeah, a lot of the companies that are in there, even though they're in the silver mining ETF, they mine more gold than silver, or they mine more, base metals than silver, because it's so hard to find a pure silver mine these days. So yeah, it's important food to keep in mind for thought. Um, all right. Well, Mike, I assume what you'd probably like to see here at some point is some consolidation, right? Some sideways trading to kind of take the froth off, let the moving averages catch up to where prices are. Um, don't let me put words in your mouth, but I think you would think that that would be a good sign that you know prices would be more sustainable.
Absolutely. I mean, it's not sustainable for silver to go up $5 or $6 every day, on a base of 80 or 90. The best thing that could happen probably is some consolidation and then a move higher. I've said oftentimes that in big bull markets, you'll see an asset or a group double off of a base. And I pointed out that the gold and silver miners have doubled and even a little bit more off their big base. And I could share some charts, but suffice it to say they've had a double and then some. And then if they would just consolidate here, I think that they could double again, particularly the silver miners over the next handful of months. So I think it could be quite a move. I wouldn't bet everything on it, but yeah, if we could see some consolidation, it would be really good. Okay, and
Okay.
one last thing I'd like to say before I wrap up is that, and John alluded to some of this earlier, we're starting to see a number of sectors, high relative sectors, really break out. And I could share just a couple quick charts, and then we can pause. So just sharing, like for instance, Latin America, a piece that's in our portfolio John talked about. Look at that. Latin America has just been a monster mover. And then industrials, another key piece that we have is in there. Pick, metals and mining. boom, just really taking off. Industrials doing well. And healthcare, big update today. And we talked about the equal weight S&P, big update today. So relative strength analysis is starting to work and the strong sectors are getting stronger. So we might really be seeing a broadening of the market that could make us launch a little bit higher here. We'll see. Um, and that could take the miners higher too. We could have a situation where everything goes up, you know, a blow off, so to speak, and then and then falls. So to me, it looks like the tailwind is there for everything, for all of that to happen.
All right. Well, whether it does or it doesn't, folks, we'll have Mike and John in here week in and week out going forward across the rest of the year to be giving us an audible update every week so we can stay, very close to the pulse of what's going on. Gentlemen, thank you so much for joining me here again. John, I'll punt it back to you just real quick. Because you guys are talking to so many people, you've got a great pulse of the heartbeat of just the average investor, especially the average investor or the average viewer of this channel and what they care about. I got to imagine you guys are getting requests with like, okay, my precious metals position has tripled. What should I be doing here? What else is on people's minds right now?
Yeah, well, certainly the headlines, whether it's we're going to take over this country or that country,
Hmm.
people, and yesterday, like even yesterday, the markets were down pretty healthily, stock and bond markets. Thankfully, our client portfolios were actually barely changed on the day, and we had a couple of clients reach out to us and say, "Wow, I was actually surprised. I was expecting to see a bloodbath." And don't get me wrong, there are days where our portfolios underperform and things like that. So it's not a victory lap, but people are very. I raise that just to say that people are a little bit elevated attention to the news headlines, and that could be a good or a bad thing. Usually a bad thing when it comes to investing because
Well, if
these
it's making them
headlines.
emotional, their decision
Yeah,
making, it's a
exactly.
bad thing.
Exactly. And one day is usually not gonna, make a trend and that kind of thing. So we're having some, conversations like that, settling people down. We did a pretty good job not, we had good gains in client portfolios last year, but we were able to kind of mitigate a lot of realized gains. So we didn't have big, and we very intentionally pushed those off to this year. We thought that this year for a lot of people would be a better year to book some gains. And so we're actually having some of those thoughtful conversations now about, realizing some of those gains that we
Hmm.
help clients defer into this year. What else? I mean, we always get a smattering of people that, hey, reached a new year. I'm another year older, or this is the year I'm going to retire. What do I need to start to think about? So we do a lot of financial planning stuff that covers all the bases you can imagine, well beyond just the investment tactics. But yeah, those are things that come to mind.
Okay. Well, let me just again underscore what you just said there, which is, last couple of months we were encouraging people to get in touch with their advisors to make sure they handle all their end of year planning stuff. Um, I think we said this last week, but very important now that it's the beginning of the year to update your financial plans and your game plan for the year so that you can get all your ducks lined up accordingly now and then spend the rest of the year executing towards your goals as opposed to, you know, the procrastinator who calls you guys up in October and says, "Oh, what should I be doing to maximize my situation for this year?" And you're like, "Well, maybe get a time machine and go back to the beginning of the year." Well, right now you've got the time machine, so use it well.
Absolutely.
All right. All right, gentlemen. Well, thank you so much. Everybody, if you'd like to see George come back on the channel, let's say in Q2 to give us an update, please let him know that by hitting the like button and then clicking on the subscribe button below if you haven't already, as well as that little bell icon right next to it. I want to remind folks who are, still attracted to the precious metals trade that Miles Franklin, Andy Schechtman's firm, is still offering their exclusive offer to the Thoughtful Money audience for buying junk silver from them at very attractively low prices. They started the promotion off at being able to buy junk silver from them at a dollar under spot, given the multiple margin rate hikes at the CME. That was then raised to $1.35 above spot, which is still historically really low premium. And then because they got some more inventory in, they've been able to lower that a little bit. So now the offer is you can buy junk silver from them at just 99 cents above spot. So if you want to learn more about that, maybe take advantage of it, just fill out the very short form at thoughtfulmoney.com/buygold. And when you fill out that form, Andy and his team will be in touch with you right away. And if you fill out that form, it's not just for the junk silver offer. If you've got other questions about buying, selling, or storing precious metals, they can help you with that too. Lastly, if you would like to get some help in, maybe updating your financial plan, or just how to position your portfolio for 2026, especially if the year looks the way that George thinks it might, highly recommend you get that help from a quality professional financial advisor. If you don't have one or would like a second opinion from one that I think meets the criteria of a good professional financial advisor who takes into account all the macro issues that are discussed on this channel, then consider scheduling a free consultation with one of the advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you'd like to talk to Mike and John themselves. They're at New Harbor Financial. To set up one of those free consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. There's no commitments involved. It's just a service that these firms offer to be as helpful to as many people as possible. John and Mike, gentlemen, thank you so much. Mike, I'll let you have the last word before we close up here.
I really don't have much more to say. I just think it's an exciting time. I think it's late in the game. Be careful out there. If you're not an active trader, just severely reduce your equity. We'll sit on cash. And we'll be doing the play-by-play here every week. And thanks for that opportunity.
All right, well said, Mike. Okay, gentlemen, thanks again for joining me for yet another week. Everybody else, thanks so much for watching.
I think we'll see new highs in the next 12 months. And I think we'll retest the highs in the next 6 months. So retesting meaning 50 in the next 6, and then breaking out to new highs in the next 12 months. I could be wrong on the timing, but it certainly seems like that's a very intriguing timeline to follow because of the volume we're seeing of purchases post days of declines. We're seeing clearly the outperformance of silver even when gold is falling, and the reaction that even technical analysts that tend to push these movements from a momentum standpoint are beginning to see the probably greatest cup and handle we've seen in history that is still not, have not ended. We still need to see the other side of that handle really break out.
The silver will retest its previous high of around $50 within the next 6 months and likely break out to new record highs within a year. While the exact timing could vary, the outlook is supported by strong buying activity on market dips, silver's resilience compared to gold, and technical patterns, particularly what may be the largest cup and handle formation ever observed, that suggests a powerful breakout is still ahead. Tavi Costa is a macro investor and portfolio manager at Crescat Capital, best known for his deep research on commodities, precious metals, and global macro trends. The classic cup and handle pattern starts with a massive price surge, like what happened in silver during the 1970s, followed by a peak in the 1980s and then a long period of decline and loss of confidence that lasted about 20 years. That long downturn marked the bottom of the market, and by the early 2000s, silver began another cycle, eventually retesting its previous highs. Each time prices return to those old highs, selling pressure often increases because investors fear a repeat of the past. However, the recent decline in silver wasn't as deep as the crash of the 1980s, and the industry has recovered more steadily this time. Now, silver is once again pushing toward its historic $50 peak, and with so much momentum behind it, many believe a breakout is coming. In markets, there's a saying that there's no such thing as triple tops, suggesting silver won't stall out again, but instead move higher once it clears resistance. For investors, the takeaway is clear: prepare for the possibility of much higher silver prices, but the broader setup strongly favors silver's long-term upside. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support, and enjoy the video.
if you think of how a cup and handle is formed, initiates with a large movement that is usually unprecedented, which happened in the 70s and then peaked in the 80s. And then you have this complete loss of faith and a peak of a bubble. And that goes on for a long time, 20 years or so, of which was the case until the late 90s. And after we saw that, that was the very bottom of that market. So we went all the way up and created the beginning of another cycle, which was the early 2000s, until we retested the highs of the prior bubble. And so investors look at those two things and say, well, that looks like, that same issue we had in the past. And so the selling becomes more pronounced at those levels. And it's normal to see that type of pressure creating another long-term decline. The difference is that this decline although it was very difficult for those invested in this industry. I wasn't involved with the industry personally, but I clearly that decline really shaped the industry in a big way as well. But it wasn't as deep and steep as we saw in the 80s. So that decline, although marked, in a huge way, the history of silver, it was definitely, much easier to stomach relative to the 80s. And so now, we're seeing another movement to push again to that same level that we saw the peak of the bubble in prior times. The thing is, there's so much energy behind this to see the price breaking out. There's a joke that we say in markets, there's no such thing as triple tops. And there we have it, approaching a triple top. There's going to be maybe a moment where we hit that 50, and nobody knows if that's going to be the case. But there's a very high likelihood that we may hit the 50 and people will say, well, that might be it. We might hit a peak here. I don't think that will be the case because cup and handles break out. And so we may see a short-term movement. This is why I said 6 months to get to 50, 12 months to break it through it. But I do think, regardless of the timing of how this whole thing will resolve, I think the resolution is we're going to see much higher prices. So if you're investing in the space and you have that view, you can apply that in markets. Look at if you're running a mining company, you can see this. All right, well, there's a clear path that we may see a break of silver prices. What is my biggest risk here? One, that I'm wrong. You could always be wrong. But two, how do I secure my margin? Because that's the biggest thing. That's your biggest treasury. So this is why I'm urging people in the space to say, protect your margin, because your biggest risk right now is energy. It's not the stock market, it's energy. And in some cases, investors may have issues with maybe labor costs and others. And so it depends on the structure of your cost. But usually energy is about 30% of your cost, particularly coming from open pit projects. And so, yeah, that's the way I'm envisioning this whole thing. And as an investor, if you are in that side of the market, then, act accordingly. Think about companies that will be in a great position if prices reach those levels and plan for that, really try to plan for it. And yeah, that's the way I invest. That's the way I do my things. And, if things change and the plans change and there's another pandemic or something along those lines come and we have a major change in markets, sure, I'm allowed to change my views. But having a plan is important. And so that's how I'm trying to approach this.
Tavi Costa explains that gold has led precious metals and hard assets for a while, but markets often rotate leadership between commodities. Although gold functions more like a currency, it has acted as a commodity and signaled the start of a long-term bull cycle in the sector. Recently, however, other metals and related assets have begun outperforming gold. Tavi relates this situation to April 21st. Gold has moved mostly sideways, while the TSX Venture, heavily weighted toward precious metals, rose over 30%, and silver gained double digits. This shows investors are becoming more comfortable with gold, and are now moving further along the risk curve, seeking higher returns in less liquid assets like silver and mining stocks. The trend suggests we're entering a phase where other metals catch up to and potentially outperform gold. Moreover, Tavy exposes that we're in what could be called a golden age of mining, as profit margins are exceptionally strong with gold and silver prices far above production costs. However, this may not last forever, so miners should hedge energy costs to lock in profitability. At the same time, the industry faces a major challenge. Reserves are being depleted, few new discoveries are coming online, and exploration budgets remain low, leaving most major miners with very limited replacement reserves. Now, let's just dive into the interview.
Yeah, I do. I think that would be a normal behavior of the metal. We've had, gold really leading the pack of precious metals and hard assets for some time now here, especially in the commodity space. And I think investors that understand the commodities, sector very well will appreciate the fact that there is a rotational dynamic that usually happens where a commodity will take the lead versus another at certain times. And I'm not here to claim that gold is necessarily a commodity. I do view it as a currency, but it acts as a commodity in that case. And I think gold has been signaling that for some time now that we've seen finally the beginning of a long-term cycle in this whole industry. And we're now what seems to be the beginning of other metals and other derivatives of the gold-related trade or investment starting to outperform gold itself. If you look at the gold price all the way back to just April 21st, when right after the whole situation with tariffs and so forth, the Liberation Days, which happened in the 7th, but gold really peaked in 21st. We've seen gold basically go sideways. And at the same time, we saw the TSX Venture, which marks a lot of especially if you look into the subgroup of precious metals, that whole space was up about 30+% during the same time that gold was basically flat. So, certainly there has been an exercise that I call of acceptance of risk occurring across investors that are looking for the next thing after gold. That doesn't mean gold is going to go away as a trade, but it means that investors are so comfortable with the gold idea that they're starting to go down or go up on the risk curve and go down on the liquidity curve in order to hopefully capture more returns. And I do think that's going to be the case. And so, I'm paying attention to that because silver has also outperformed gold since, silver's up double digits since gold has been basically flat and down, in fact, since April 21st. So all these things are really interesting. And I think that's the beginning of other metals catching up to gold prices finally. We're seeing what I like to call the golden age of mining, mostly because the margins of these companies are just outstanding. And you can see that in many ways, especially looking at the gold to oil ratio, the silver to oil ratio, and obviously looking at the median cost to produce gold today or silver is drastically lower than the actual price of those commodities or those metals. And that's probably, I don't know if that's going to be the case for the long haul, because I do think energy cost is way cheaper than has ever been relative to metals. And so if you're a producer, you definitely want to be making decisions to hedge energy costs if that's a big issue for you as a miner. I think that's a very important point to to hopefully miners will take that strategy as an approach to secure some of those margins over the long haul. We certainly have done that with our own mine, San Cristobal, which is the 4th largest silver mine in the world. We have instructed them to, and they have done it, basically hedge their energy costs for the 3 years out. And I do think that that's, eventually, we all know So we were talking about political constraints. Let's talk about industry-wide constraints. One of the largest ones certainly is what we have in terms of the depletion of reserves and no new discoveries coming online. If you think about how many development stories are going to be coming online to become producing assets, it's very small. And also, if you look at the exploration budget across most of the major companies and how much they have found in terms of added ounces, and it's also very small. So the replacement reserve is actually very low today across most of the majors.
Silver appears to be on the verge of a historic breakout, supported by strong technical patterns, resilient fundamentals, and a shift in investor appetite from gold toward higher risk, higher reward assets. Mining companies stand to benefit enormously, but only if they manage costs and secure future reserves. For investors, the setup points to a rare opportunity in both silver and quality miners, though timing and risk management remain key. Do you think silver will finally break above its $50 resistance this cycle, or will history repeat with another stall? How should mining companies balance short-term profitability with the urgent need to replace dwindling reserves? Please leave a remark in the section below with your ideas. Please remember to subscribe to receive updates, and if you find this helpful content, kindly give it a thumbs up. We are grateful that you joined us on this journey.
If bonds are getting inflated, if real estate is getting inflated, in the CPI, they decided that you don't actually own your home, you rent from yourself. So it's a rental equivalent of it's insane is what the CPI is. But this sort of corroborates what I was saying, that the truth lies somewhere in the middle. $12,000, that is actually a reasonable target if gold goes into the same type of bubble that it was in back in 1980. The M2 is probably, and it ended up right in the middle. And so, yeah. So $1,000 silver is possible. I doubt it, but triple digits, I think that's a slam dunk, like I've said many times. And so silver is incredibly undervalued right now.
Recent analysis suggests that gold could reach $12,000 per ounce, mirroring the speculative surge seen in 1980. However, such a scenario requires a significant global crisis or a major shift in monetary policy. Currently, gold is trading at approximately $3,500 per ounce, indicating a substantial gap to this projected high. As for silver, while reaching $1,000 per ounce appears highly improbable, the metal is considered undervalued. Factors such as increasing industrial demand, particularly in electronics and renewable energy sectors, along with a widening gold-to-silver ratio, suggest potential for price appreciation. Mike Maloney, a well-known precious metals expert, author, and economic educator, highlights that gold has historically preserved purchasing power, but it also experiences bubbles, something it's not in yet. Compared to past decades, gold now buys far more stocks and real estate. Both gold and silver remain undervalued, with silver especially lagging behind even inflation-adjusted levels. Gold's popularity has rebounded to 23%, still below its 2011 peak of 34% after the 2008 crisis. Unlike 2011, today's volatility stems from policy and market factors rather than systemic threats. The World Gold Council reports that central banks purchased a record 1,037 tons of gold in 2024, continuing a multi-year trend of official sector buying. Silver prices in 2025 are expected to follow a steady upward trend, with a notable acceleration in the fourth quarter, during which December could see highs of $42.44. This growth may be driven by increased industrial demand amid global energy transitions and supply chain constraints. Investors are likely to view silver as a strategic hedge, particularly in light of ongoing geopolitical uncertainty and persistent inflationary pressures. Both gold and silver are experiencing notable market dynamics, influenced by macroeconomic factors and investor sentiment. Before we examine the video, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
Well, yeah, he's the great hedge to maintain purchasing power is true over the centuries, but there are times when it goes into bubbles, and it's not in a bubble yet. If you want to increase, if it were true that it has only kept up with inflation, then right now the Dow Gold is at like 12 to 1, and it was 45 in 1999, 2000. I believe it was like 38 when I first started investing. So I can buy like 3 times more stocks with my gold. I can buy a whole lot more real estate with my gold and silver than I could back then. So it's gaining in purchasing power if you're buying it at the right time, because it goes through these overvaluations and undervaluations. And when you measure it against, decades of history, what you see is that we are still in a severely undervalued state right now. So it's gold and silver. Gold, if you use the CPI, yes, it's corrected against inflation. Exactly. That's what causes a peak, is everybody trying to rush into it at the same time. And what we are actually seeing in the retail sector is low sales volumes right now. The public is still like yawning when it comes to gold and silver, and they're chasing the stock market right now, which is the Buffett indicator is just in insane valuations. When this next crisis happens, it's going to be one of the worst that has ever happened, because there's so many things are just so skewed. But what's interesting here is you have the shadow stats CPI, also called the shadow stats alternate CPI. Now, a lot of people think, oh, well, that's just some nut putting together. No, John Williams was an insurance actuary. And in the mid 80s, all of his models stopped working, and he was wondering why. And he started researching it. And then he found that the government was changing the way that they calculate inflation. They kept on messing with the CPI. And he went back and what he uses for this alternate CPI is the government numbers from World War II to 1982. The method that the US government used to calculate inflation. So these are both sets of government numbers. One of them keeps on getting massaged periodically. Anytime the CPI is coming in too hot and it makes the administration look bad, it seems to get adjusted. So what have you got there? I've always said also that the truth probably lies somewhere in the middle. But these are 2 sets of government CPI numbers. And one of them is adjusted to sort of cheat Social Security recipients out of their full, they don't keep up with the true cost of living. And all you have to do is, if you look at the CPI and look at your personal purchasing power, where it has gone, and prices, go to a restaurant. I've been traveling. You order a hamburger and a beer in a airport. Oh my God, it's just unbelievable. So,
yeah,
gold and silver have not kept up with true inflation, the inflation that you experience day to day. So I believe that the truth lies between those numbers. But gold is nowhere near being in a bubble. And so it shows that it should be, if the green government CPI was true, then gold would be in a bubble, which would mean it would be of a large percentage of global financial assets, that it would be on the news everywhere, that every financial planner would be recommending put 30% into, what's interesting, nobody recommended gold back in the 70s until the all the financial planners switched to recommending gold. Put 10, 20, 30, 40% into your portfolio after the peak in 1980. And there's a movie called Brewster's Millions with John Candy and Richard Pryor. And Richard Pryor is going to inherit a whole bunch of, it's like $33 million or something like that.
Gold and the US dollar typically exhibit an inverse relationship. When the dollar strengthens, gold prices often decline, and vice versa. This dynamic is primarily due to gold being priced in dollars. A stronger dollar makes gold more expensive for holders of other currencies, reducing demand and thereby lowering its price. However, recent market conditions have highlighted a more complex interplay between these two assets. As of August 14, 2025, gold prices extended their rise for a third consecutive session, bolstered by increasing expectations of a U.S. Federal Reserve interest rate cut and a weaker dollar. Spot gold edged up to $3,357.65 per ounce, while the dollar remained near multi-week lows, aiding gold's appeal. Ongoing conflicts, such as the Russia-Ukraine war, have driven investors to seek safe haven assets like gold, even when the dollar is strong. Global central banks, particularly in Asia, have been increasing their gold reserves to diversify away from dollar-denominated assets, providing steady support for gold prices despite the US dollar's strength. Persistent inflation has kept gold attractive as a hedge, even in a strong dollar environment. The dollar's decline boosts gold's purchasing power. Mike believes silver reaching $100 to $200 is inevitable. Historically, silver has experienced significant price surges during periods of high demand and limited supply. While reaching $200 per ounce would represent a substantial increase from current levels, silver has surged in 2025, reaching multi-year highs, driven by strong demand and safe haven buying amid global economic and geopolitical tensions. Major financial institutions, including HSBC, Citigroup, and Bank of America, have raised their price forecasts, citing tightening supply and robust demand. When gold hits around $5,000 an ounce, investors may shift to silver just as they did in 1979. Despite these gains, experts like Michael Oliver consider silver undervalued and see potential for significant upside. Market dynamics, including industrial demand and limited supply, support continued growth. However, investors should remain mindful of potential volatility. Now, let's memorize the interview.
Pretty nicely, sort of where it feels like it should be, which is, below halfway, but certainly not at the bottom of the valuation channel.
Right. And what's interesting here is that it's actually closer to the shadow stats line than it would have been to the CP line. And M2 is basically where all of the dollars, this is the dollars that get created by the banks and the Federal Reserve. And they go out into the economy. So this is covering true inflation. This is also covering the inflation of the stock market. If bonds are getting inflated, if real estate is getting inflated, in the CPI, they decided that you don't actually own your home, you rent from yourself. So it's a rental equivalent. It's insane is what the CPI is. But this sort of corroborates what I was saying, that the truth lies somewhere in the middle. $12,000, that is actually a reasonable target if gold goes into the same type of bubble that it was in back in 1980. We don't have lines at coin shops. We don't have it in every newspaper's headline. It's not on the news every hour. It isn't dominating, and it will. There will come a day where it dominates the news cycle. Adjusting it compared to all these other financial assets, and it's what percentage change did real estate, the stock market, the 10-year treasury, GDP, currency in circulation, M2 currency supply, what percentage change did they have from 1980 until today? Now, the numbers are somewhat different than what you just saw in those graphs because we used the intraday high of $52.50 instead of $50. So, So this corroborates that M2 scenario of inflation. and we've got the dollar is collapsing. If you take $100,000 worth of gold and it goes to $10 million, yes, the dollar is collapsing, but you can buy 10 times more cars with your gold that is pricing those collapsing dollars. It is the canary in the coal mine. And what happens during an event like when the dollars are losing value, and they have been, I can buy so much more real estate, stocks, just about everything I can buy more of today because I've been invested in gold and silver for so long. And other than cryptos, best performing asset of this century. And when you include cryptos, best performing, Bitcoin is up again. I don't know. Maybe it's not, but as of like a week or two ago, a best performing asset of this year, including cryptos. Mm-hmm. And so, yes, it is the dollar collapsing. That's part of the skyrocketing price. And that's the reason you've got to stop measuring stuff in terms of dollars. So I think the low range of where silver should go is that CPI number. That is like if we don't end up, I think triple digits is even inevitable without monetary demand. Getting to 100, 200, that still would not, compared to those other financial assets, that 200 wouldn't be in a bubble. The CPI, the current one, the low CPI is just that. It's a lie. And so I would look at $200 as probably the floor of a predicted future price. When? That's the problem. I don't know. I know that, if you look at my first book, I made like 10 different claims in them. 7 of them came true. The other 3 have yet to come true, but they will. It's just taking a lot longer than I thought. 2015, so the price of silver is more than double what it was then. But still, that gives you an idea. And that 1980 rush, that's what a bubble looks like. That's when silver was in a bubble. It's nowhere near that today, but that day is coming. And I do feel that it'll be somewhere around $5,000 an ounce gold, where people will look at it and go, wow, this was $250 an ounce in the year 2000. I think, maybe the silver is a better bargain. Mm-hmm. They'll think there will come a day where they think gold is too expensive. That happened in 1979. Gold had gone from $35 to $400, and people changed their preference in late '79 from gold to silver once gold was perceived as being a little bit on the expensive side.
Investor sentiment, geopolitical conflicts, and macroeconomic factors influence the complex environment in which gold and silver are navigating. Silver remains relatively inexpensive and has considerable room for growth, while gold maintains its purchasing power and continues to enjoy robust demand from institutions. Supply shortages, industrial demand, and safe haven purchasing all support both metals, indicating that prudent allocation now could yield significant returns in the years to come. Investors will continue to need to keep a close eye on market variables, such as inflation, dollar swings, and international crises. How will central bank purchases and continued geopolitical tensions affect the price of gold and silver in the upcoming year? How can the price trajectory of silver change if investor preference shifts from gold to silver? Please feel free to express your opinions in the comments section below. If you found this helpful content, please remember to subscribe to remain updated and to give it a thumbs up. Thank you for joining us on this journey.
I think China is going to shock the world, and the Chinese bond market is going to grow, and it's going to become the biggest as well. De-dollarization and the growth of the yuan, overseas yuan bond market. And that has been one of the linchpins, an overseas bond market for demand for the dollar. In London and in Europe, we've had what's called the Eurobond market, where dollars abroad are issued or lent to corporations. Australia's Fortescue said on Friday it had secured a yuan-denominated loan worth 14.2 billion Chinese yuan, $1.98 billion, to ramp up its decarbonization plans. I know I have an opinion about that, but I'm just trying to look at de-dollarization and the rise of the yuan.
China is positioning itself to shock the world by rapidly expanding its bond market, which could eventually rival or surpass the US market, reinforcing the broader trend of de-dollarization. UBS estimates China's domestic bond market at around $25 trillion US dollars, ranking among the world's largest. Beijing is also drafting new rules to strengthen cross-border yuan financing, making it easier for banks to support offshore yuan lending and bond issuance. Meanwhile, China is cutting its U.S. Treasury holdings, diversifying into agency bonds, gold, and other non-dollar assets amid rising geopolitical tensions. Now, yuan-denominated debt is taking on that role, as shown by Australia's Fortescue securing a 14.2 billion yuan loan to fund decarbonization projects. This shift highlights how the yuan is steadily gaining ground as an international financing tool, reducing reliance on the dollar. Mario Ineco, a former City of London bond trader turned independent financial analyst and commentator, points out that non-G7 nations have been working to reduce their reliance on the US dollar, not to replace it entirely but to gain more self-reliance, especially after years of US sanctions and political pressures. Much like finding a new bank when the old one becomes restrictive, these countries are building systems to trade and finance among themselves without always going through the dollar. While experts once argued it would take decades for China to become a major player due to its underdeveloped bond market, that is changing quickly. Overseas firms are increasingly issuing panda bonds, yuan debt in China, to access lower-cost financing and hedge geopolitical risk. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Countries, we're trying to basically become less dependent on the dollar system. Not because they want to destroy the dollar, but because they want to be more self-reliant. They don't want to depend on the dollar alone. And one of the reasons for that, of course, has been the regime of sanctions and other political punishments by the US in the last 15 years. And it's akin to you having a bank account with a particular bank, and this bank starts making it hard for you to deal with them. Well, you're going to look for another bank. And I think the Global South, or the BRICS, if you want to call it, really, they're not really looking for another bank. They're not really looking for another reserve currency. They're looking for another system that they can deal amongst themselves, that they don't have to go through the US dollar, a third-party currency. And yes, back in 2017-18, when I started talking about this, it wasn't even on the radar screen, but now it's becoming more and more important. And what I want to talk about today is something about the bond market, which is a market that, of course, I worked in for over 20 years. It wasn't the corporate bond market, but it was the government bond market. But it's a very important market. The bond markets are the biggest markets out there. They're bigger than the stock market or the equity market. And I remember Jim Rickards actually talking about reserve currencies and whether the yuan or the Chinese renminbi would become a major reserve currency. I don't remember exactly how many years ago, maybe at least 5, maybe 7, 10 years ago, he said, yeah, China is never, well, not never, but he said it would take decades for them to really have a major part in the world's monetary architecture, trade architecture, because they don't have a bond market like in the US, a deep bond market, but that's also changing very quickly. China seems to do everything very quickly and very well. And I'm not like defending China or its political system. I'm just looking at the facts. And that's what a lot of people have a problem doing. They get too bogged down in the politics and things like that, instead of looking at the numbers and the facts, of course. So I'm seeing a lot of stuff about China. For example, Vince Lancy posted this yesterday. Yuan bond growth. Countries are beginning to issue debt in yuan. Hungary's 5 billion yuan panda bond in July was the largest sovereign deal of its kind, while Russian energy firms are preparing yuan-denominated paper. So 5 billion yuan is under $1 billion. That's pretty small. But we're also seeing that other countries, and I think I spoke about this a couple of weeks ago or so, like developing countries, are swapping out of dollar debt to cut borrowing costs. And they're resorting to issuing Chinese yuan or renminbi bonds, or sometimes even Swiss francs, because they cost less.
Mario Ineco highlights that China's bond market is rapidly catching up with the US, now the world's largest at around $50 trillion, with China close behind at over $20 trillion and growing fast through government, policy bank, corporate, and panda bonds. China's bond market is set to expand further as foreign demand for yuan bonds grows, with moves like Fortescue's yuan loans signaling broader adoption. Policy changes to ease cross-border financing show Beijing's commitment, while diversification away from U.S. treasuries may weaken global demand for dollar assets. As more countries issue debt in yuan rather than dollars, global demand for the dollar is set to weaken. Mario believes China's bond market could even overtake the U.S. within the next couple of years, further reducing the dollar's role as the primary reserve and payment currency, especially as Beijing continues linking the yuan more closely with gold.
I want to look at now is the biggest bond markets in the world and why China is really catching up with the United States. So I went to ChatGPT and I asked, what are the biggest bond markets in the world? And it says, just as I told you earlier, and this I knew, I didn't have to ask ChatGPT, it says the world's bond markets are massive, collectively far larger than global stock markets. The biggest ones are concentrated in advanced economies with deep financial systems. As of the latest available data, 2023-2024, the largest bond markets by outstanding debt securities are the United States, 50 trillion in outstanding debt securities. U.S. Treasury market alone is the most liquid and important benchmark globally for now, but corporate, municipal, and mortgage-backed securities are also make it enormous. Number two, yes, it's China, the second largest bond market, around $20 trillion plus dollars, driven by government bonds, central and local, policy bank bonds, and a growing corporate bond segment. Number three, lagging way behind, is Japan, 12 to 13 trillion. Euro area is around 20 trillion, but that's different countries, right? UK is 4 to 5 trillion. And I also looked at how the growth of the Chinese panda market, they call it the panda bonds. I guess it's foreign companies borrowing in yuan. That's been growing quite significantly since 2023, 2024. So it's really catching on. It says here, compared to 10 years ago, i.e. 2015, the market was much smaller. precise data for 2015 may be less readily available in current sources, but the massive issuance in 2023-2024 and the 1 trillion renminbi cumulative suggests a steep ramp up. So there you go. That's the panda bonds, panda bond market. So all that's going to mean is that there's going to be less demand for dollars because, yeah, when you borrow in dollars, yeah, you want the dollars, right? So there's more demand for the currency. But if that's changing, and I'm not saying it's going to happen overnight, all these things kind of take a little while. As I said, I started talking about the demise, let's say, of the petrodollar back in 2017. And here we are 8 years later, and it's almost like complete, and it's accelerating. And the same thing's going to happen for the bond markets. And I think it could be a lot quicker than 8 years. We could see in the next year or two the Chinese bond market overtaking the US bond market. And that, in my opinion, will mean that the dollar is going to continue to lose its status as the major reserve currency, even major reserve, a major form of international payment. And of course, I think China is making the renminbi kind of linked to gold a lot. And I'm going to talk about that, of course, with Eric Young. So look out for my interview with him about that. So yeah, let's quickly look at where the markets are this morning. It's 7:30 a.m. London time, so I'm quite early. Spot gold is pretty steady. It's basically unchanged here at 36.43. The low has been 36.26. The high 36.47. Silver is also unchanged, trading at 42.20. High's been 34, and the low's been just below 42. So very quiet markets so far. I expect they will get busier later on. I notice the U.S. Treasury yields, they're creeping up a little bit. The 30-year yield is back to 470. It's up 2 basis points. The 10-year as well is up 2 basis points at 408. Yes, it has come off a bit in the last week or two. And of course, the whole focus this week will be the Fed's decision on Wednesday. It's almost a done deal. They're going to cut by 25 on Wednesday. The news is coming out at 2 p.m. Eastern time or 7 p.m. London. The other thing to watch from that meeting is what they're forecasting, their dot plot chart going forward, and also the press conference. See what is said there by the chairman of the Federal Reserve. So the currency market and stocks are fairly quiet so far.
Will political and regulatory obstacles impede China's bond market growth, or may it eventually catch up to the United States within the next 10 years? If large economies started issuing the majority of their debt in yuan rather than dollars, how might the world's markets respond? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.